Crypto assets have been a hot topic lately, to say the least. Trading in cryptocurrencies like Bitcoin has sent prices on a wild ride, raising a lot of questions about how they should be valued, how to trade them, and whether or not you should make them part of your portfolio. Now, to be sure, crypto assets are a relatively new and highly risky investment vehicle. A lot of the rules, standards, and regulations are still being written around the space. Some people have made a lot of money with them, while others have been on the losing end of the trade. We've not designed this class to convince you to invest in crypto assets. That's purely up to you. Your enrollment in this class proves you're interested in learning more about crypto assets. Hi there. My name is Ian King. I've been a trader and investor for 20 years, spanning many asset classes and market cycles. My career started as a desk clerk on the mortgage bond trading desk at Salomon Brothers, and I eventually ran a successful hedge fund during the 2008 financial crisis. For the last 5 years, my focus has been on the cryptocurrency space, and I'm excited to share this knowledge with you as an Investopedia instructor. Thank you for your enrollment. By the end of this course, you'll be able to assess the crypto asset markets, decide which crypto asset investments are worthwhile, adapt to changing crypto markets with the understanding that every boom has its bust, and how to capitalize on this pattern. You're going to develop your own unique process for becoming a better trader, as well as construct actionable trading ideas using technical analysis that will help improve your potential risk-reward ratio on every investment. So how you take this course is up to you. You can take it sequentially, section by section, or you can skip around and watch the content that most interests you. This course also has a workbook that you can download, follow along and take notes. There's also a glossary of terms and some quizzes to test your knowledge. So without further ado, let's get started. Before you start investing in crypto assets, you need to understand where they come from and how they work. By the end of this section, you'll be able to distinguish between multiple attributes of the blockchain system, compare the differences between proof of work and proof of stake, and provide examples of the 3 different types of crypto assets. So let's start by talking about the blockchain. What is this technology that people are considering to be transformational? First, if you take out your mobile phone and take a selfie, then send that photo to somebody else, you'll know that there's 2 copies of the photo now in cyberspace. The blockchain allows you to create a digital asset that's unique, and that if you transfer it to someone else, there's still only one of those digital assets. And that was the original thinking behind the Bitcoin whitepaper, a peer-to-peer cryptocurrency system where there's a unique digital asset that can be easily transferred, and everyone sees the transfers occurred. So let's see how this ecosystem breaks down. First, the most important part of the ecosystem is likely the developers, because these are the computer programmers that write the code, design the system, and are responsible for upgrading and maintaining the network. Next, you've got miners. And miners are a large network of computers and supercomputers that will secure information to the blockchain securely and allow you to access it when necessary. And lastly, you've got users. Users are just like you and I. We're the ones who are going to use these digital networks to transfer something of value. Now, the way this space operates is very reflexive. If you have a strong team of developers and you've got a large network of miners, you're bound to have a big group of users. So when we start evaluating how these different blockchains and cryptocurrencies work, we have to first think about how strong is the foundations underneath them. Now, everyone tries to understand what's a decentralized system, and can you give an example of one? Well, think about this for a minute. If you were to go to the bank and transfer $100 to your friend, you go up to the teller, and they check the bank ledger to make sure you have the funds in your account, and then they make sure your friend has an account in the bank, and they do the transaction for you. They're not really moving money per se, as opposed to just making a record in a ledger where your funds exist. So if you think of that in a decentralized way, it would look like you standing on stage in a town hall, and there's 10 people in the audience with ledgers, and you announce something, I want to send $100 to my friend, and each of those people with ledgers checks to see you have the funds in the account, and then writes down the transaction. Now, if one person doesn't hear what you said, you don't have a problem because there's 9 others that are in agreement. But what happens if 6 of those individuals with ledgers in the crowd decide that what you said wasn't really true? And this is how blockchains operate. They try to come to a consensus among groups of individuals to agree on something and to validate that something is true. And they do this by using a native digital asset. And that native digital asset is considered a cryptocurrency or a crypto asset. So let's give you a few attributes of the blockchain. First, like I said, they're a decentralized system. In this case, you can have information not just to those 10 people sitting in your audience, but to any computer running the network in the world. Next, information is added in a cryptographic fashion. And what that means is you can see that there is something there, that there's some value there, but you can't access it without a special or a private key. And lastly, information is added in a way that's totally immutable. Once a block is created in a blockchain, it can never be reversed without having more than 51% of the power of the network. And you'll see when we start talking about the different consensus mechanisms that secures these networks that it's almost impossible. So let's start discussing the different consensus mechanisms that incentivize these networks of information to come to an agreement. And the first one is called proof of work. And what proof of work does is it basically burns a lot of energy to create security. So however much energy is burned on one side is how much security you wind up with the other side. And so proof of work is exactly how it sounds. You have to prove that some work is being done. And in the crypto space, in proof of work, you solve a cryptographic puzzle. This is a long, complicated algorithm that's solved by a network of miners. And these miners, like I said, can be anywhere and everywhere. If you want to join the network, all you need to do is buy a mining machine to create hashing power. And more on that later. And lastly, what's important to understand with proof of work is that you have a Coinbase reward. So when a miner solves the cryptographic puzzle, they're given a reward. And how this fits into the whole equation is that remember those groups of people that were sitting in your audience with the ledgers? Now, pretend at the same time they're trying to solve an algebra equation. And the person who solves the algebra equation also has to add the information they've received from people on stage making announcements to secure that block. And if they win that block, they get the cryptocurrency payment. So there's some different pros and cons to proof of work that I'd like to get into. Now, the first pro of proof of work is that because it's so inherently decentralized, it's the most secure system. Because you can have a blockchain that has miners literally everywhere in the world. There's no limitations to it. Now, there's some problems with that, though. There's going to be a really high cost of capital. And one of the main problems with proof of work is that it burns so much energy that there's estimates that the blockchain takes up the entire energy for the country of Morocco in a single day. And lastly, one of the cons is miner loyalty. How do you ensure that miners, once they're mining your coin and securing your network, will actually stay there? What happens if there's a sell-off in your cryptocurrency? Maybe those miners find something that's more lucrative. So you have the problem with miner loyalty. And so that is proof of work in a nutshell. And here are some proof of work protocols. You've got Bitcoin, which is obviously the most famous. Litecoin, which is a derivation of the Bitcoin blockchain. It was a fork in Bitcoin's code. You've got Monero, which is an anonymous way to secure cryptocurrency on a network. And lastly, you have Ethereum, which is now a proof of work protocol, but will be moving to a proof of stake at some point. And I'll explain that in the next video. So we just reviewed proof of work and some of the main limitations to that consensus mechanism. So now I'd like to discuss proof of stake, another consensus mechanism that helps secure information onto these networks. The first thing to understand about proof of stake is that there's no miners involved. Instead of mining, you're going to have a network of stakers where coins are staked. And these individuals are responsible for validating all the transactions that occur in the network. And what's important about these stakers is that if anyone is a bad actor, they're going to lose their investment. And in fact, if you have someone on the network that is an adversary, everyone is going to lose the value of their coins because the market value of them will decline significantly. So let me discuss some pros and cons to proof of stake. Now, in proof of stake, the benefit is obviously it's very cost efficient and it's very energy efficient. There's no mining. There's no need to purchase a high-powered algorithm or computer to run those transactions. But the cons are important as well. In proof of stake, you have a problem with distribution because if someone owns a majority of the coins, their value that's staked will start gaining more compound interest than people with a smaller stake. And that quickly can turn into a monopoly. So one of the questions these proof of stake protocols have is how you evenly distribute the coins so that nobody winds up with a monopoly. The other con is that you don't have access to the coins when you stake them. So you have to enter an agreement that I'm going to commit my digital tokens for X amount of time and I'll receive this payment in return. However, when you have them staked, if the market value of your coin drops off, you have no way to sell it. So that's a negative in proof of stake. Now, some of the protocols that use proof of stake, and there aren't as many as there are in proof of work, are OKCoin, you've got Dash. And Dash is a very interesting one because to be a staker in Dash, you have to run a supernode, and that requires buying 1,000 coins and staking them. Dash's current market value goes between $500 and $1,000, so to be a staker, you have to have a pretty significant capital commitment in the Dash network. Another one is Neo, and lastly, you've got Redcoin, which is a social media-focused proof of stake. Now, there's a lot about the crypto markets that's similar to other asset classes. And when you trade them, it might feel like trading stocks or Forex. But it's a brand new asset class, and it's important to keep that in mind. The main difference with the crypto assets is that they've gone through a period of rapid evolution like no other marketplace has ever before. Bitcoin started about 10 years ago and has gone from trading at a fraction of a cent to over $10,000. There are now Bitcoin futures. These markets are evolving so fast, and they go through bear markets and bull markets not in years, but this happens in months right now. Next, there are a variety of investors. For the first time in any market, venture capitalists are competing against hedge funds, who are competing against day traders, who are now competing against mom and pop investors. I don't know any asset class that has ever dealt with so many investors at one time. Also, and this is a warning, there's some significant technology quirks. These exchanges have basically come out of nowhere in the last few years, and they don't really have the support staff to manage as many customers that are migrating into the space as now. For instance, in December of 2017, 3 of the most popular exchanges shut down to new investors. Now think about that for a minute. They're so popular that they had to close their doors temporarily. So that's one main technology quirk to consider when you're moving into the crypto space. And lastly, these are early stage investments. So none of these have real proof of concept in the real world. And they're more like venture capital investments. And the reason why they're so volatile and why we've never seen anything like this before is we never publicly traded a venture capital investment. They were always traded on private markets, and they were very illiquid and not open up to the public. So these are 4 main factors to consider when you're moving into the crypto markets. Now I want to start talking about the general taxonomy of crypto assets. And first we'll begin talking about cryptocurrencies. You may have heard that term before, and in fact it was widely used to describe anything in the blockchain space because Bitcoin is the original crypto asset and it's also a cryptocurrency. Now, to be a currency, you have to fulfill a couple standards. And there are a few principles that currencies are all governed by. And the first one is that a cryptocurrency, or any currency, has to be a medium of exchange. It has to be something that you can transfer and someone is willing to give you a goods or service in exchange for it. So it has to be widely accepted. The next thing is that a cryptocurrency needs to be a unit of account. And that just means it has to be a standard unit of measure that other goods can be valued at. And lastly, a cryptocurrency needs to be a store of value. Now, when I say store of value, it doesn't necessarily mean that if you put your money into a cryptocurrency like Bitcoin or Litecoin, the value will increase. The value can go down. A store of value just means that your money or your value can be held in these cryptocurrencies or any currency in general for time, and then you can go back and retrieve that value, even if it went higher or lower. For instance, in the gold markets, gold is considered a store of value, but it doesn't mean that gold's value always increases. There are times when there's a deflationary environment when the price of gold actually goes down. So that's something to keep in mind when they say store of value. It doesn't necessarily mean the value will increase over time. Now, the next crypto asset I'd like to discuss is the crypto commodity. In the real world, a commodity is something that you can purchase and be used for other means. For instance, oil can be used to power a car or power a factory. And crypto commodities are decentralized assets that fulfill similar capabilities. Now, in the crypto space, the first crypto commodity can be held for computational power. There are decentralized networks that are being created, and some are already available, that allow you to do high-end computational calculations that you could only do with a supercomputer. Now there are protocols that allow you to pay for computational power in a wide variety of networks in a very dispersed way. The next crypto commodity deals with network bandwidth. So there are protocols in development right now that will actually allow you to share networks among people. And it'll allow you to pay for these networks in a decentralized way with no centralized point of control. And lastly, there are crypto commodities for storage capacity. There are ways for you to compensate someone for using their storage in the cloud in a decentralized way where you don't need a centralized point of control. So the last category of crypto assets I'm going to discuss are known as crypto tokens. Now, in the real world, a token is a unit of account that has a specific purpose. Think about going to an arcade and taking tokens, and you can only redeem those tokens to play video games or pinball games in the arcade. If you go out to a bodega or a grocery store, they're not going to accept your tokens. So crypto tokens are forms of a cryptocurrency that have a specific purpose. Now, these can be redeemed for such things as digital goods or services. Now, what's a digital good? Think about it like music. Perhaps a band wants to create a unique piece of music that you have to buy using a digital token that's native to their blockchain. Next, most of these tokens are built on the Ethereum platform, and this just gives them a set of rules that governs how the tokens can act and who can create them and who can also use them. And lastly, tokens are also used in social networks, media, and games. Think about Facebook's Farmville, how you're able to buy a virtual cow. In the crypto space, you can use crypto tokens to purchase unique pieces of digital goods in the virtual world. So let's look at these different crypto assets. And now you're going to look at a website called coinmarketcap.com. And this is a very robust data set of crypto assets, and it's got a list of every cryptocurrency that's traded anywhere in the world on a crypto exchange. Now, you'll first notice in the top left, in cryptocurrencies, there's 1,522 of them. That's 1,522. The total market cap for the space is right now at 450 billion. And the other thing I noticed is that the Bitcoin dominance is 38.8%. And what that means is that Bitcoin makes up 38.8% of the market value. It's been as high as 95% in the past, and this is considerably low. Now, the way the data is aggregated in coinmarketcap.com is by market cap. So you'll see that Bitcoin is the first, Ethereum, Ripple, Bitcoin Cash, Litecoin, and so on. You can see the price of each of these crypto assets. Right here, Ripple trades at 0.959245. Here's the 24-hour volume of Ripple, 467 million. And here's the circulating supply. And you'll also notice on the right-hand column the percent, and these are the 24-hour changes. And one thing to keep in mind is that crypto assets are extremely volatile. You'll see one of these crypto assets, Quantum, up 13.6% today. Nano is up 26%. And the last indicator on the right side is the 7-day price graph. So just you can get a visual representation of whether or not this asset is moving up or down. So let's look into some more information on a popular crypto asset named Tron. So when you click on the Markets tab, it'll show you a list of all the exchanges and pairs where Tron is traded. And you'll notice that on the Huobi and the Binance exchange, they have the most volume, 39 million and 38 million. And this is important because in the crypto asset space, you can only access these coins on the exchanges where they're listed. And you might have some geographic restraints, whereas if you live in a certain area of the world, some of these exchanges might not be available to you. So it's important before you go and buy a crypto asset to figure out where exactly you can go and do that. Also, you also want to focus on where there's the most liquidity, and this is going to occur where the most volume happens. So if you ever want to exit a crypto asset quickly, you'll know there will be more buyers on the exchanges that have more liquidity. Now in the crypto space, you've probably heard the terms coins and tokens used interchangeably, but there's an important difference between the two, and let me explain. Coins are their own protocols and platforms. Bitcoin is a protocol. Ethereum is also a platform. These are considered coins. Now, tokens rely on these platforms. And what they do is they represent a unique piece of value that sits on top of the platform that has to be redeemed for something else. So for instance, on top of the Ethereum platform, you have a token called Golem. Now, Golem allows you to pay for supercomputer or a decentralized supercomputer using a Golem token. So that's the key difference. The coin represents the underlying technology or platform, and the token sits on top of it. Now, in the Ethereum world, there's been a huge rush of tokens that have been created in the last year. In fact, there's over 1,000 of these decentralized applications with their own unique tokens. But it's important to understand that they're all built on the Ethereum platform. So this concludes section 1. And now you should be able to distinguish between the different attributes of the blockchain system. You should be able to compare the difference between proof of work and proof of stake, the consensus mechanisms. And you should also be able to provide 3 examples of different crypto assets. The blockchain allows you to settle something of value almost instantly. In the case of banks, wiring money overseas can take days, sometimes even weeks. So it's no wonder that the banks are currently exploring ways that they can integrate blockchain into their payment systems. For instance, Ripple is a popular cryptocurrency that's based on a distributed ledger, mostly run by the banks, that will help them settle transactions and move money quickly and more efficiently over blockchain rails. Goldman Sachs-backed Chain recently bought Poloniex for $400 million, and this is a popular exchange to trade crypto assets. Morgan Stanley recently listed a job opportunity for cryptocurrency analysts. So I think there's also demand from their customers to learn more about blockchain and cryptocurrencies and figure out how that banking customers can make it a part of their investment portfolio. Bitcoin was developed as the first peer-to-peer cryptocurrency where something of value can be exchanged between 2 people without the need for a middleman. The early implications are remittance payments. So someone working, let's say in the United States, can immediately transfer something of value back to their family, let's say in Mexico, South America, or China instantly without the need for a payment solutions provider like Western Union to send the payment. Now that's just the first low-hanging fruit of cryptocurrency. But what we've created here is a censorship-resistant, immutable form of digital value that can embed records such as property rights onto a blockchain, and we can agree that all those property rights exist in one place. In the developing world, property rights are a huge issue. In fact, there's about $6 trillion worth of unlocked capital in the developing world because they just don't have a good standard of property rights. For instance, if you travel to Central America and you might ask somebody where they'll live, they tell you, well, go up to the bodega, make a right, and then he's the third house on the left. There's no correct street addresses, and no one can agree that one person owns that property. When you can agree on something such as a property right, then the bank can give you credit for that asset. Or if someone wants to buy it, they can go get a loan from the bank. And so this unlocks $6 trillion, an immense amount of capital in the developing world. And not only does this provide banking services for the 2 billion people who are unbanked in the world, but it can also provide government services that aren't properly provided currently. You hear a lot about valuation of crypto assets, but what does that mean? And how do you do that? By the end of this section, you'll be able to apply crypto valuation techniques, use metrics to monitor the health of the blockchain ecosystem, and explain crypto asset mining. So let's begin talking about how you value crypto assets. And remember, crypto is an entirely new asset class. So what we're going to try to do is apply some of the same principles from other asset classes to crypto. And the first thing I want to consider is the difference between intrinsic versus extrinsic value. This is something that was proposed in the early 20th century by a famed stock investor named Ben Graham. And intrinsic value means value in and of itself, and extrinsic value is what the market perceives or projects on the asset. So it's important to consider when you think about crypto assets because some have utility value and some also have speculative value. Utility value is what is the crypto asset used for and what does it pay for, whereas speculative value is what does the market think it's worth. Now, think about this for a minute. Let's say you have a decentralized file storage system and there's only $10 million worth of decentralized file storage that's being used right now. However, the market might value your crypto asset at 500 million, which is 50 times how much is really used in the world. So in this case, the utility value is only 10 million, and the speculative value would be 490 million. And you'll see when we start discussing the other types of crypto assets and their values that many of them mostly rely on speculative value. So let's now talk about crypto asset valuations. Why do they have so much value? And I want to talk about a blog post that was written by a guy named Joel Monegro of Union Square Ventures a few years ago. And in this blog post, he described the value captured in the web. Now in the web, you can see the protocol layer is very thin. And by protocol, what I'm referring to is a way of doing things. So in the internet, the protocol could be SMTP, or Simple Mail Transfer Protocol, or ICTCP, which is Internet Transmission Control Protocol. And you may not have noticed, but these protocol layers really have no value. Most of the value that's been created in the web sits in the application layer. Think of companies like Google and Amazon and Facebook that sit on top of these protocols as applications and how valuable they are. Now the blockchain turns this on its head because for the first time we've developed a protocol layer that has different consensus mechanisms like Bitcoin and Ethereum and Litecoin, which are native assets to the protocol layer. So you've created economic value now in this protocol layer. And what that means is the application layer actually is really thin and it feeds into the protocol layer. So the application layer in the Bitcoin and crypto space would be companies like Coinbase and Bitstamp, or exchanges like Bittrex. What these companies do is they're applications that sit on top of the protocol layer and they actually help it grow. The more customers that sign up for Coinbase, the larger the protocol layer where Bitcoin sits is going to grow. And so that is one way to think about why there's so much value in these crypto assets. So here's the main dashboard for Coinbase. You can see it's a very user-friendly layout. I would note that Coinbase offers FDIC insurance up to $250,000. So any funds you might have in US dollars are secure on Coinbase. And if you look at how Coinbase is laid out, it gives you the four main crypto reserves to buy: Bitcoin, Bitcoin Cash, Ethereum, and Litecoin. There's a pretty interesting chart functionality here where you can switch between different time frames. So you can see how Bitcoin performed in the last year, up $9,500 or 796%. It lays out your portfolio really nicely and also gives you recent activity. Now, something that might be a little different between Coinbase and other and stock trading platforms are the Accounts tab. When you click on the Accounts tab, what you have here are wallets. And the wallets don't really hold your digital coins. They just hold your key. And that's basically that you have these coins reserved on that specific blockchain. And I'll talk more about that in future lessons. But just so you know, here on Coinbase, you get every wallet. If I click on my Ethereum wallet, I can see the transactions that happen in this Ethereum account where I sent Ethereum to over the last month. So let me just click on the Bitcoin wallet and show you something. So in a date in the recent past, I sent Bitcoin to this Bitcoin address. And if I click on this, it tells me how much Bitcoin I sent, where it was sent, and then how many confirmations it's had so far. And what these confirmations represent are blocks. And this 1841 means that there have been 1,841 Bitcoin blocks created since I sent this confirmation. And the further back in the past that these confirmations go, the more secure this transaction is. Now, if I highlight this exact address and I copy it, and I go to a website such as blockchain.info, I am able to click on the search tab, paste that address in the search tab, and actually search for that wallet. So I can see the wallet history that's happened since this wallet was open. And you'll see here that here's the address, and here's the hash symbol. This is the basically notifies where this sits on the blockchain, along with other transactions. It's got 2 transactions so far in this wallet, and it's received 0.009 BTC, which is equivalent to about $100. So you'll notice that there's a history of every transaction that's happened in the Bitcoin blockchain. And if you have that specific public address, you can go see how many coins were sent to it or how many coins were sent out of it. And this is one interesting feature about the Bitcoin blockchain and any blockchain, is that there's a public record of any funds that were sent or received. So blockchain info is a very effective tool in searching for a public address that identifies a wallet on the blockchain. In our next lesson, we'll get more into wallets and exactly how they work and the different types of them and the different security features. Now, if developers are the brains behind the blockchain, miners are the beating heart. Now, miners are a decentralized network of computers that are solving computational puzzles for a reward in order to secure and validate truth. Now, in the Bitcoin ecosystem, miners are responsible for verifying and confirming transactions, and the health of them is measured by what's known as hash rates. Now, I'm going to look at a chart here of hash rates over a couple of years. And you can see back in February of 2016, the hash rates, and this is the estimated number of terahashes per second, which is trillions of hashes per second, started around 2 million. And it's grown exponentially over the last couple of years, and now we're up at about 25 million terahashes per second. And what this tells me is that the Bitcoin market, or the security of the Bitcoin ecosystem, has grown extremely more secure. Because in order to recreate this, you'd have to have as much mining power as already exists in the system, and buying terahashes per second is not cheap. So this is why Bitcoin is the most secure network or decentralized network that exists today. So we covered the developers, who are the brains behind the blockchain, the miners, who are the beating hearts of the blockchain. Let's talk about the users. Users are the stomachs of the blockchain. People like you and I who use these digital assets for real-world purposes. There's a couple ways to evaluate user health in a blockchain, and the first is transactions. If you're using a cryptocurrency, you want to see that people are freely spending it in the real world. Next, wallet growth. And this can be measured on websites like blockchain.info. You can see how many users have wallets and how many people are on that specific network. And lastly, merchants. You want to see that there's a strong growth in merchants who are willing to take your cryptocurrency in order to determine its health. So I'd like to quickly go over the confirmed transactions per day in the Bitcoin ecosystem. And this comes from blockchain.info. And one thing you'll notice here is that transactions in the Bitcoin world really have not grown much in the last couple of years. You had a spike in late 2017, but the amount of daily transactions has pretty much stayed the same. Next, blockchain wallet users. Now this is something that's shown very healthy growth in the Bitcoin world. In fact, it's growing exponentially. Just about every year, the number of blockchain wallet users doubles. In March 2016, we were sitting about 3.5 million. A year later, in March 2017, it had grown to 12.5 million, and then it doubled again to now in March 2018. So it's important to see that people are joining these networks to determine whether or not it's healthy. And lastly, this is a website called spendbitcoins.com, and this will show you all the merchants that accept Bitcoin. And right now, it estimates there's over 100,000 merchants that accept it. So you can use websites like these to see if your cryptocurrency can be spent somewhere. When you're talking about valuing crypto assets, there have been approaches that have taken other valuations in asset classes and applied them to the crypto space. And this is one of them. It's called the network value to transaction ratio. It was proposed by an early Bitcoin adopter named Willy Woo. And basically what you do is you take the network value of a specific protocol and you divide it by the dollar value of the transactions. And you can think of this like a price-earnings ratio. In the stock market, you might have a stock, let's say Apple, that's priced as $200 a share, and you have an earnings of Apple at $10 a share. So you would divide 200 by 10, and you get a price-earnings ratio of a stock of 20. You can do a similar metric with the network value to transaction ratio in the cryptocurrency space. And let me get into that. So right here, you're looking at a chart. The top price level is the price of Bitcoin over the last few years, and below it is the network value to transactions. Now, there's a couple key points to note here. One is that when network value to transactions gets close to this 100 level, there tends to be a sell-off in the Bitcoin market. The other point to make is that when it drops to about 50, it signifies a bottom. So there are some traders or investors who see value in the Bitcoin token when it drops to 50. And in fact, in 2017, there were significant sell-offs that took the network value to transaction close to 50, and these, in turn, became rallies in the price of Bitcoin. So if I line these up, here's the first one, which produced a rally. Here's the second one, which created another rally. Here's the third one, which led to another rally. And this didn't drop all the way down to 50, but there was also another rally. Now, when we had this super high in Bitcoin in late 2017, the network value of the transaction climbed as high as 175. And then since then, it's sold off. So most recently, the NVT has dropped below 50, and we'll see if this produces some sort of recovery in the future. Another valuation technique in the crypto asset space is known as the equation of exchange. Now, in economics, this is known as the quantity theory of money. But as proposed to the crypto space was done by a guy named Chris Brzezinski. Now, the equation of exchange essentially is simple. MV equals PQ. And that stands for money times velocity equals price level times quantity. And let me break this down really simple. This is an accounting identity that says what is bought must equal what is sold. So when we talk about equation of exchange, there's one function or parameter that we're really not still sure of, and that's what is velocity. So velocity means how much a unit of account or a dollar turns over a given time period. Let me explain. In the US markets with the US dollar, we have a velocity of about a little over 5. Now we know in the US markets with the dollar, you can't spend it as quickly as you can spend things online in the digital space. So crypto velocity is widely understood, and in order to understand this equation of exchange, you have to make some pretty big assumptions. But let me walk you through this to see how it could possibly be something that values how much a crypto asset is worth. Now, I gave you MV equals PQ, that's money base times velocity equals the price of money times the quantity needed. So let me go over this. In the US system, we have an asset base of about 4 trillion in US dollars, and times that by a velocity of about 5, and this is equal to our GDP. So our GDP in the US is about 20 trillion. So 4 trillion here times velocity of 5 gives you 20 trillion. Now, how do you measure the value of Bitcoin? Well, you have to think of what are some of its use cases that we can apply to an equation of exchange. And we know the world remittance market is about 500 billion. And let's say Bitcoin were to take about 50 billion out of the global remittance market. So 50 billion, and it would be how much Bitcoin is needed times its velocity equals 50 billion. And to solve for this, you would take velocity, and let's make the assumption that velocity is the same as the US dollar market, and it's 5. So one use case of Bitcoin means that we need 10 billion of US dollars purely for remittance payments. Now this is also additive, so you can think of other use cases of Bitcoin that you can also add to this. So let's take the gold market. Gold is a $7 trillion market. Perhaps Bitcoin takes up about 10% of the gold market, so that's another 700 billion use case. But gold, the velocity is a lot lower, because when you're holding gold, you're storing it somewhere. You're not freely trading it like you are with remittance payments. So a quick assumption to say is that the velocity, let's say, is 2, and the gold market, which is 10% of 7 trillion, would be 700 billion. So now the Bitcoin needed would give you a $350 billion market cap, because you take 700 divided by 2. So this is a simple accounting identity, or an equation of exchange, that shows a simplified way to value Bitcoin or other crypto assets. So this concludes section 2, crypto valuations. So now you should be able to apply different crypto valuation techniques. You should know how to use metrics to monitor the health of the blockchain system. And you should also understand crypto asset mining. Bitcoin, Litecoin, Ethereum, Bitcoin Cash, Tether. I'm sure you've heard at least 2 or 3 of these mentioned when it comes to cryptocurrencies. But do you know how they started, or what problems they were designed to solve? Which is the most valuable? And how do you value them? At the end of this section, you'll be able to compare the different reserve currencies and differentiate value and usefulness of these reserve currencies. So in this section, we're going to talk about the different crypto reserve assets. But first, let's give a background on what exactly is a reserve asset. Now, when you think of reserve currencies, the first thing that comes to mind is the US dollar. And since World War II, the dollar has been the reserve currency. It's widely held by other central banks. It's also very liquid. It has the deepest financial markets. And lastly, the dollar is considered a safe haven. If there's any exogenous shocks around the world, other countries and governments buy the US dollar as protection. And what's interesting to note about the dollar as the global reserve is that the US economy was the largest economy in the 19th century, but it wasn't until World War II that the dollar replaced the English pound as being the global reserve. So these are some important context to put things in before we start talking about the different crypto assets in the space. Now, here's a chart of the total market cap of every single large crypto asset. And you'll notice that Bitcoin was the only game in town for years. In fact, it wasn't until January of 2017 that Bitcoin's market share, which was over 80%, really started to fall. In 2017, you saw the rise of Ethereum and Litecoin. And then in August of 2017, the Bitcoin blockchain forked and you had Bitcoin Cash come around. You've also seen a rally in other coins, different altcoins. I showed you in an early lesson that there's now 1,500 cryptocurrencies, so they fall in this category of altcoins. So it's important to keep this in mind, the different assets and what percent they make up the total system when you're thinking about what exactly you want to invest in. Now that you understand what a reserve currency is, let's move on and talk about the crypto reserves. Now you've seen that a reserve currency is something that's both widely held and freely traded on multiple exchanges, and also offers more liquidity than other ones. And so that's why I've named this category the crypto reserves. They're Bitcoin, Ethereum, Litecoin, Tether, and Bitcoin Cash. When it comes to the crypto reserves, Bitcoin is the OG. It was created in 2009 by a pseudonymous person named Satoshi Nakamoto in an infamous white paper. Now, what Bitcoin first proposed is a solving of the double spend problem. It was a way to transfer or make a peer-to-peer transaction with no middleman. And what's important about the Bitcoin white paper, and things that I touched upon in previous lessons, is that it incentivizes consensus. Consensus among untrustworthy actions, or miners, a network of them. And because we've incentivized consensus, we can come to a truth. And this is what the proof of work consensus mechanism details. Now, importantly, there's some limitations to Bitcoin. And the most common one is that the block size problem. Now, Bitcoin blocks can only reach 1 megabyte in size, and that limits the transactions per second to about 4 to 7 transactions per second. If you compare that to Visa or Amex or other existing payment networks which transact 2,000 transactions per second, you can see that Bitcoin has had some problems scaling as a transaction mechanism. However, there are some protocols in the works, specifically the Lightning Network, which will allow for off-channel payments of Bitcoin and create the ability to have more transactions per second than both the Visa and the Amex network. So it's a very exciting development for Bitcoin, and I'm expecting it around summer 2018. Now, the second largest cryptocurrency is Ethereum. Now, Ethereum has many similarities to Bitcoin, but there's also some improved functionality. It was proposed in 2013 by a genius named Vitalik Buterin. In fact, after he wrote the Ethereum white paper, he thought he was going to go back to school. His life really changed after that. Ethereum is a decentralized global computer. EVM stands for the Ethereum Virtual Machine. Now, with Ethereum, you can write these conditional contracts. You can base contracts on some logical steps that need to be met before payment is sent. So you can think about different businesses we can run off a decentralized global computer. For instance, they're already piloting flight insurance off of it. If you pay a certain amount for a flight and your flight doesn't leave within 2 hours, then you're compensated for the flight not leaving. And this is done in a decentralized way. There's no person that needs to check whether or not the flight left. The computers do it. So there's a standard that Ethereum has created called ERC20. And off the standard are written these tokens that have been part of the ICO boom in 2017. And these are all decentralized applications that run on the Ethereum platform. Remember all those tokens we spoke about in an earlier lesson. Now, one thing to note about dApps is you can see them on stateofthedapps.com. There's over 1,000 of these protocols available. And if you go to that website, you can go research and see everything that's built on the Ethereum blockchain. Now, the next crypto reserve currency is Bitcoin Cash. Now, Bitcoin Cash is a little controversial because it started as a fork to Bitcoin's blockchain. And by fork, what I mean is there was a group of developers and miners that decided they didn't like the way things were going with Bitcoin, so they created a fork in the network, and this maintained the same DNA as Bitcoin with some slight modifications. The problem with the original Bitcoin network was it really Satoshi's vision? Bitcoin had grown so large that it was unable to handle as many transactions as were trying to be processed. I noted in an earlier lesson that with a 1 megabyte block size, you only get 4 to 7 transactions per second. Now, Bitcoin Cash increased the block size to 8 megabytes, which should facilitate more transactions per second and more commerce. Now, Bitcoin Cash wasn't really taken that seriously in the beginning, but in December, it was added to Coinbase. And once it was added to Coinbase, the value of Bitcoin Cash jumped dramatically, sometimes 2 to 3 times in one specific day. And since then, people are more freely trading and owning Bitcoin Cash than in the past. So it looks like this crypto reserve currency is here to stay. The next crypto reserve currency is Litecoin. And if Bitcoin is digital gold, Litecoin is considered digital silver. Now, Litecoin was founded in 2011 by a programmer named Charlie Lee. And I'm mentioning his name because in late 2017, he liquidated all of his holdings. So if you're thinking about buying Litecoin, just understand that the incentives of the founder might not be aligned with your investment. Another thing to consider about Litecoin is that everything is 4 times Bitcoin. It's a fork of Bitcoin's original blockchain, which accounts for 4 times the amount of currency in circulation and 4 times the speed of block creation. Bitcoin blocks are created once every 10 minutes. Litecoin blocks are created once every 2 minutes and 30 seconds. Bitcoin has 21 million outstanding coins. Litecoin has 84 million. And what this was intended to is to speed up transaction speeds. And so this is a lightweight client or a lightweight use of Bitcoin that can have faster scalability and adaptability. So the next crypto reserve currency I'm going to talk about is Ripple. Now, Ripple isn't really a cryptocurrency. You have to understand that Ripple is not blockchain based. It's used by a group of shared databases which are mostly owned by the banks to settle transactions. And one thing to keep in mind about Ripple is that there's no scarcity value. The Ripple founders have said they have the capacity to print 100 billion of the XRP tokens. And in the Bitcoin world, you have scarcity value. Bitcoin can only issue 21 million tokens. So far, 18 million have been issued. In Ripple, you've got 50 billion outstanding tokens. Its supply could potentially double. And the founders have also noted that they have the capacity to print even more if necessary. What I will tell you about Ripple is that in late 2017, when the cryptocurrency markets were really rallying, the price of Ripple went from 25 cents to about $5. And that left a lot of blockchain experts really scratching their head because, like I said, there's not much scarcity value in Ripple tokens. What happened was, and what we think happened, was that when new users entered the crypto asset space, they looked at all the prices on CoinMarketCap of different cryptocurrencies they could buy, and they saw Bitcoin at 12,000 or 13,000, and then they saw Ripple at 25 cents. So in the newbie investor's mind, they might look at something being 25 cents as more valuable than something that's priced at 10,000. And they didn't even consider that there's no scarcity value to Ripple. And so speculators drove the price of Ripple up to a price that, and a market cap that almost eclipsed Bitcoin's. And since then, the market value has fallen dramatically, but just know that sometimes things can be really irrational in the crypto asset space. Now, the last crypto reserve currency is Tether. Now, Tether is a controversial project that tries to become something of a crypto fiat currency. And what I mean by that is Tether tries to be pegged to the US dollar. And why is this important? Well, in the crypto space, if you were to buy Bitcoin or Ethereum and move that Bitcoin or Ethereum onto an exchange and trade it for another altcoin, you can't trade your altcoin back for US dollars. It's just not supported. What you can do, if your exchange has tethers on them, you can sell your altcoin and move into Tether, which is supposed to be a stable coin and represent the value of the US dollar. Now, there's supposed to be $1 in Tether's bank accounts for every 1 USDT that's been printed, and it's controversial because it's closely linked to the Bitfinex exchange. However, we haven't had an audit of Tether's books for the last 5 months. So time will tell if they're really purporting how much USDTs there are as value there is in the bank account. The last part of the crypto asset space are altcoins. Now, altcoins are named that because they're alternative cryptocurrencies. Altcoin terminology first came as an alternative to Bitcoin, but now altcoins refer to basically anything that's not the reserve currencies. There's 1,500 altcoins and growing, and in fact, 3 to 4 are printed almost every single day. Now, what's important to know about altcoins is they have a higher beta than the reserve currencies and a much higher beta than Bitcoin. And what that means is, if you look at a correlation between an asset and another one, a higher beta means that an altcoin will move more than any reserve currencies because it carries a lot more risk and they're more speculative. So that's something to keep in mind when you're looking at investing in altcoins, that they do tend to carry more risk than the reserve currencies. So that concludes our section on crypto reserve currencies. Now you should be able to compare the different crypto reserves and be able to differentiate the value and usefulness of these crypto reserves. I think there's been skepticism and opposition to using Bitcoin as a form of payment, most likely because the price has risen dramatically over the last year and people are skeptical of whether it can retain that value. However, with any new technology, there are always skeptics. There were people who didn't think that cars would be driven on roads. In fact, in England, they passed a red flag law in the 19th century that required someone to walk 25 yards in front of your car with a red flag to say that the automobile was coming. There are still people that use the post office, even though that's a less efficient way of sending something via mail. You can send an email instantly and not have to wait a few days for the post office delivery. So I think with every new technology, there are skeptics before that technology is readily adapted. But in Bitcoin, for instance, we just have a new way and a better way of transferring something of value across networks that can happen instantly. So someone in New York can send something of value to somebody in Beijing, China, instantly. And this is the first time we've been able to accomplish that. And of course, I think people who are comfortable doing things the old-fashioned way are skeptical of it and not readily adopting it just yet. Before you dive into the deep end, you need to know how to swim. The same goes for investing and trading crypto assets. At the end of this section, you'll be able to access the crypto markets via an exchange, identify different types of wallets for your crypto assets, and connect to multiple exchanges. Now, when you're considering buying any crypto asset, the first thing you have to think about is where I'm going to buy a crypto. And it's not like other asset classes. For instance, in the stock market, if you want to buy a stock, you can log into E-Trade or TD Ameritrade, type in the ticker symbol, and you can automatically buy it. In crypto, things are a bit different. And so there are some key considerations you have to think about before you buy a crypto asset. The first is fiat to crypto. Now, to move into these markets, there are only a limited number of exchanges that take either US dollars, euros, or yen. So you have to find what those exchanges are and exchange them for some of the crypto reserves. For instance, Coinbase accepts Bitcoin, Ethereum, Litecoin, and Bitcoin Cash. The next consideration is location. There are some geographic limitations and restrictions as to what exchanges you can use, especially if you're a US customer. So this is a consideration when choosing an exchange. And lastly, you have to think about which coins you want to trade. Not every exchange supports every altcoin. So if you go to coinmarketcap.com and you pick a specific ticker symbol and then click on markets, you can identify what exchanges trade the coins that you're looking to trade. Now, a couple examples of major exchanges are Coinbase, which is connected to the GDAX exchange. Now, Coinbase is US-based. They have over 13 million customers. They've just recently passed Schwab in the number of customers, and they're the largest exchange in the US. But Coinbase has its limitations. You can only buy Bitcoin, Ethereum, Litecoin, and Bitcoin Cash. You can't buy any altcoins. Now, to do that, you have to purchase one of these crypto reserves on Coinbase and then transfer them to another exchange, such as Bittrex. Now, Bittrex is a US-based exchange that was founded by a couple of Amazon engineers that supports about 100 different crypto pairs. Another exchange is Binance. Binance is similar to Bittrex, except it's based in Hong Kong, and it's definitely not as user-friendly as Bittrex is. Another exchange is Bitfinex, which is the largest altcoin exchange. However, it's restricted to US customers. And finally, in the United States, you've got Poloniex. Poloniex is restricted in New York State. You can't access it because of the New York BIT license. So if you live in certain areas like New York, you cannot access Poloniex to trade altcoin pairs. One other thing about Poloniex, as we're filming this, they were just bought yesterday by a Goldman Sachs startup for $400 million. And what that tells me is that there are some major investments going into these exchanges that are really going to help with the user experience in the future. Now, let's do a live login to Coinbase to show you exactly what these exchanges look like. So here's the main dashboard for Coinbase. You can see it's a very user-friendly layout. I would note that Coinbase offers FDIC insurance up to $250,000. So any funds you might have in US dollars are secure on Coinbase. And if you look at how Coinbase is laid out, it gives you the four main crypto reserves to buy: Bitcoin, Bitcoin Cash, Ethereum, and Litecoin. There's a pretty interesting chart functionality here where you can switch between different time frames. So you can see how Bitcoin performed in the last year, up $9,500 or 796%. It lays out your portfolio really nicely and also gives you a recent activity. Now, something that might be a little different between Coinbase and other and stock trading platforms are the Accounts tab. When you click on the Accounts tab, what you have here are wallets. And the wallets don't really hold your digital coins. They just hold your key. And that's basically that you have these coins reserved on that specific blockchain. And I'll talk more about that in future lessons. But just so you know, here on Coinbase, you get every wallet. If I click on my Ethereum wallet, I can see the transactions that happen in this Ethereum account where I sent Ethereum to over the last month. So let me just click on the Bitcoin wallet and show you something. So in a date in the recent past, I sent Bitcoin to this Bitcoin address. And if I click on this, it tells me how much Bitcoin I sent, where it was sent, and then how many confirmations it's had so far. And what these confirmations represent are blocks. And this 1841 means that there have been 1,841 Bitcoin blocks created since I sent this confirmation. And the further back in the past that these confirmations go, the more secure this transaction is. Now, if I highlight this exact address and I copy it, and I go to a website such as blockchain.info, I am able to click on the search tab, paste that address in the search tab, and actually search for that wallet. So I can see the wallet history that's happened since this wallet was open. And you'll see here that here's the address, and here's the hash symbol. This is the basically notifies where this sits on the blockchain, along with other transactions. It's got 2 transactions so far in this wallet, and it's received 0.009 BTC, which is equivalent to about $100. So you'll notice that there's a history of every transaction that's happened in the Bitcoin blockchain. And if you have that specific public address, you can go see how many coins were sent to it or how many coins were sent out of it. And this is one interesting feature about the Bitcoin blockchain and any blockchain, is that there's a public record of any funds that were sent or received. So blockchain info is a very effective tool in searching for a public address that identifies a wallet on the blockchain. In our next lesson, we'll get more into wallets and exactly how they work and the different types of them and the different security features. Now, the term crypto wallets is kind of a misnomer. When you think of a wallet, you think of something that's in your pocket that you can pull out that has cash or credit cards or coins in. In the crypto world, a wallet doesn't store your coins. Your coins are always held on the blockchain. What a wallet is, it's a piece of software that stores both your public and private keys. Now, if you have both public and private keys, this allows you to send and receive any of your digital assets on the blockchain. But you can't do that unless you have the private keys. Now, I showed you that the public keys are fine. Anyone can look at your wallet. They can see what transactions occurred on it on the blockchain. However, you can't move those coins unless you have access to the private keys. Now, there's a couple different ways of storing your crypto that are really important to highlight: hot wallets and cold storage. Now, in a hot wallet, it's something that's held online. And this can happen if you hold coins on a crypto exchange or in a desktop wallet or even on a web wallet. Now, with hot wallets, they're really convenient, but your coins are never fully secure. Anyone that hacks into this exchange is going to have access to your coins. Anyone that puts a virus on your desktop can also have access to your coins because now they have the private key and they can move those coins out. With cold storage, however, everything's held offline. You can hold them on a hardware device, or you can just write down or print out your public and private keys on a piece of paper. Now, with cold storage, they're much more secure than hot wallets, but they're not convenient because if you want to trade the Bitcoin that's held on your cold storage on a piece of paper, you first have to move those coins to an exchange that lets you trade against. So these are the key differences to understand when you're thinking about what type of wallet you should use to secure your crypto assets. So let's discuss the different types of wallets. What are they, and what purposes do they serve? And also talk about some pros and cons of each. Now, in the wallet space, the most prevalent wallet is going to be your web wallet. And the reason for this is that any coin or digital asset that you hold on an exchange is held in a web wallet. The exchange holds both your public keys and your private keys. And that means anyone who hacks into an exchange has access to your digital assets. And we've seen hacks before, most notably with the Mt. Gox attack in 2013. Now, the second type of wallet is known as a desktop wallet. So this is a piece of software you can download to your computer, and you can move your private keys in there. And so the only access that someone would have is if they have access to your computer. The problem with this is if you download malware or some type of virus, someone can hack into your desktop wallet and move your coins elsewhere. The next type of wallet is a mobile wallet. And so a mobile wallet is similar to a web wallet, but it's something that holds your private keys on your phone. Now, obviously your phone has a lot of security. Most phones either have Face ID or Touch ID. The problem with mobile wallets is that if someone calls your cell phone provider and proves that it's you and clones your phone, they immediately have access to all of your coins that are stored, or your private key that's stored on your mobile wallet. The next type of wallet are hardware wallets. So this is a USB stick that you can plug into your computer, and you can move your private keys off your computer safely onto a hardware device. Now, what's interesting about that is that someone would need that piece of hardware in order to access your private keys. So you can store this piece of hardware or USB stick in a vault somewhere or in a safe at a bank. And lastly, you've got paper wallets. Now, paper wallets and hardware wallets are cold storage. A paper wallet is just going to save your public key and your private key in a way that you can easily store it somewhere. So those are the 5 different types of wallets with some pros and cons. And a couple things to keep in mind: that every time you set up a wallet, you should have a mnemonic phrase. So this is a phrase of 20 words that can identify and recreate that wallet elsewhere. So if you were to lose your hardware wallet, for instance, if you have your mnemonic phrase, you can buy another hardware wallet and restore the same assets or digital assets and private keys on a separate device. The second is that you need to keep your software upgraded. Make sure you have the most recent downloads and make sure these are secure downloads coming from the programmers themselves. And lastly, always use two-factor authentication. 2FA is an app that you can have on your mobile device that gives you a random string of numbers that you need to input before you access any of your wallets. So that concludes our section on preparation. Now from this section, you should be able to access the crypto markets via an exchange. You should be able to identify the different types of wallets that you can store your crypto assets in, and you should be able to connect to multiple exchanges. To protect your cryptocurrency portfolio, ideally you would want to keep everything in cold storage. You want to keep them either on a hardware wallet, such as a Nano Ledger S or a Trezor, or even written down on paper stored in a vault safely somewhere. However, cold storage isn't entirely functional because you have to go retrieve those coins if you want to trade them or exchange them for something else. So if you're going to keep coins online, either in a desktop wallet or an exchange, make sure that your assets are diversified. Don't keep them all on one exchange and don't keep them all in one desktop wallet. As long as you remain diversified, you have less chance of losing all your assets if there is a hack of whatever particular wallet you have your coins in. The crypto asset market is volatile and risky, but also potentially lucrative if you have the proper strategies in place. That's what this section is all about. By the end of this section, you'll be able to develop a strategic trading process, overcome biases, explain why HODL, holding on for dear life, is just not a strategy. You'll also be able to identify trends using price and time, summarize why the trend is your friend, and how to draw a trend line. There is a saying in trading that goes, if man was always right, he'd own the world in a month. But if he never learned from his mistakes, he'd never own anything. I'm going to talk about some common mistakes that traders make that you need to identify if you're making them in order to improve on them. So most common mistakes, the first are position size too big. And in the crypto markets, this is essential because in 2017, Bitcoin rallied 1,400%. However, during that rally, we saw 7 pullbacks of 20% or greater. In fact, in the last few months, Bitcoin dropped 60%. If you have a position size too large, it makes it very difficult for you to stomach that volatility. Next, no edge. And what I mean is that a lot of new traders just go in the markets, they see things going up, and they just buy them. They don't really think about where to buy them, or how to buy them, or where to exit. So this is a common mistake that a lot of traders make, and we'll talk more about exit strategies in another lesson. Another common mistake is overtrading. Now the problem is, you may have gotten shaken out by a trade, and now you want to get right back in and make the same mistake again. So you don't want to overtrade because the commission costs are going to reduce your long-term returns. Another mistake, trading the junk. And I'll show a few charts in a second, but by junk, what I mean is an asset that moves up exponentially over a short period of time, and you might be holding on to something that really just has speculative value. We've seen in the crypto markets in the last year, there's just been a wall of money moving into an asset class that has a very limited supply and a limited amount of assets to invest in. So we've seen these exponential moves. And lastly, too much leverage. Now, if you're trading on the BitMEX exchange, you can get 100 times leverage on Bitcoin trades, or if you're buying crypto with a credit card, you're leveraging yourself. So let's go into a few charts so I can demonstrate what I mean by this. So this is a chart of a crypto asset called Verge. And this is a price chart of its relationship against Ethereum. Each of these candles designates 1 day in trading. And this is on the Binance exchange. Now you'll notice that in Verge, in mid-December, something happened or some catalyst appeared. And the price of Verge went from 2,500 sats all the way up to almost 50,000 sats. So in a short period of time, and this is just a few weeks, you had a 20 times return on your money. Now, a lot of traders might have gotten into this chart after it went up 3 or 4x and bought around here. Now, the problem is if you have no exit strategy, and this is purely speculative, where do you sell? So when you start trading assets like this that are extremely volatile and they start moving down, there's a tendency to kind of hold on to them for too long. And we'll talk more about exit strategies in the future, but what I want you to notice is that when you see something that's moving up as rapidly as Verge, it's not the time to buy, it's really the time to sell. Another example is Sia coin. And this is a chart of Sia coin versus the dollar on the Bittrex exchange. Again, each of these candles designates 1 day's worth of time. And Sia coin was priced at about 2.5 cents or 3 cents here in mid-December, and it went up to 12 cents. This is a 4x return very rapidly. But since that move, there was not one up day for about a month in Sia coin. So it's important to keep in mind, if you're buying any of these extremely speculative assets, where are you going to get out of them? Because like we've seen in previous lessons, there's no utility value in these coins. They're just purely speculative assets. Technical analysis helps us identify price trends over time. There's a couple key things I want to note about technical analysis. First, you want to be able to spot the trend. And what I mean by that is you want to identify if the market is trending upwards or it's trending downwards. Perhaps the market's even just going sideways. Next, entries and exits. So technical analysis can show you where the market has support and where it has resistance. And if you use these levels, you can identify where you should buy and where you should sell. Technical analysis also helps you control your risk. So because you've identified where these support and resistance levels are, you can set up buy orders and sell orders at the appropriate points. And lastly, technical analysis can help you avoid ruin. If you follow a technical analysis pattern and you're disciplined about it, over the long run, you're putting reward more in your favor and helping to minimize your risk. So let's go into a few charts right now so I can show you some uptrends and downtrends. Now you're looking at a chart of Bitcoin versus the US dollar. Every one of these candles represents 1 day's worth of time, and this is on the Coinbase exchange. Now you'll first notice that the date here starts back in summer 2017, specifically in August. And you'll note that the price of Bitcoin was trending higher throughout most of 2017. Now this uptrend ended in a classic, what's known as a blow-off top. And so think of this from an investor's perspective. First, you see the prices trending higher over time, and then this signifies to other people that prices will not go down again, so they buy at a much higher price than they probably should have. Basically, the person who is buying Bitcoin at 20,000 in an uptrend here is not really buying Bitcoin at 20,000. They're buying the belief that Bitcoin is going to 100,000 or 500,000 or 1 million. So you have all these high hopes and expectations that happen towards highs. Now, I'll note something about the crypto markets that's different from other markets is that they've gone through this rapid evolution. We've had 5 or 6 major bull and bear markets in the last decade. And that's not something that stock markets or Forex markets or bond markets go through in such a short period of time. Now, after you had this blow-off high in Bitcoin, you started the downtrend. And this is when prices quickly declined right off the bat, and this scared a lot of people out. So investors who had bought at this point of the chart are now worried that the prices aren't going up any higher, so they sell. Now, one thing that's indicative of downtrends is they're not as smooth as uptrends. You can see in this chart that there are a lot of bounces and a lot more volatility on the way down than there were on the way up. And that's something that is native to a bear market where the price doesn't go smoothly either way. They say that bear markets kill both bulls and bears because of the volatility. So I'm going to show you another chart of Bitcoin. And this is a daily chart on Coinbase and zoomed in a little bit more. So the frame of this action starts in June of 2017 and it ends in December. Now, this is how Bitcoin was trending throughout most of 2017. And you'll note here that it doesn't look as smooth once you start zooming in on this market. It's actually very volatile. So you had Bitcoin hit a price high of around 5,000 in September, but then just 2 weeks later, it dropped to about 3,200. So you're looking at a 30 to 40% decline in just a matter of weeks. Now, people who say that they bought Bitcoin in 2017 and made 1,300% gains, you have to keep in mind that it wasn't easy. There was a lot of volatility. So if you didn't buy this market at the right points, you could have lost a lot of money. Now, we've noted in technical analysis that prices tend to trend over time. But there are different types of trends, and let me explain. The first type of trend is the primary trend. And this can be a long, drawn-out, secular bull or bear market. For instance, in the stock market, we've had almost a 10-year bull market. The second type of trend are the secondary trends. And this can be a counter trend to the primary trend. So if you have a long bull market, in the middle of it, you might have a 20% pullback that lasts a couple months that signifies a secondary bear market. The next type of trend are the short-term trends. And these can last weeks to maybe months. And they can be either the same as the primary trend or counter to it. And lastly, you've got the intraday trend. And these are really short-term moves in the market. For instance, you could have a stock market that rallies 200%, but at the same time, you can still have days that drop 3 to 5%. So just because the trend is heading up doesn't necessarily mean there can't be any counter trends. So let me give you an example of Bitcoin. And this is a chart going back to 2011. And we're looking at Bitcoin here on a log scale. And what this log scale means is that on the y-axis, the distance here is separated by percent moves. So it means that a move from, let's say, 100 to 190 is going to be the same move as 1,000 to 1,900 on this chart. So you'll notice that Bitcoin has been trending higher. The primary trend has been up over time. Since 2012 to 2018, this trend is still intact. However, there's been some very vicious counter-trend moves during this time period. You can notice that in 2013, there was a 70% pullback. In 2014, there was another 60 or 70% pullback. Even in July of this year, we had a 30% pullback. And even most recently, you can see a 50% pullback in the price of Bitcoin. So just because the trend or the long-term trend is going higher doesn't necessarily mean you can't have any counter-trend moves. Now, when you're looking at a price chart, it's important to keep in mind, you're not just looking at the asset that's being charted, you're looking at the behavior of the market participants. And we've seen over time these market cycles come and go, and they really resemble other market cycles of the past. There are a couple different ways that you can look at a chart or identify price trends. You've got line charts, bar charts. Today specifically, in this course, we're going to focus on candlestick charts. Now, candlestick charts have been around for a while. They originated in 1600s in Japan to study price changes in rice. In the early 90s, they were brought to the United States by a guy named Steve Nissan in his book titled Japanese Candlestick Charting Techniques. Now, let me give you the quick basis of them. There are red and green candles. Sometimes these can be represented as hollow bodies or full bodies. But essentially, a candle shows you where the price has gone given a specific period. So if I show you a daily chart or a 1-hour chart, each of these candles represents that specific time period. And the way you want to look at this is this. The entire price move that's happened during this candlestick is from the top of the wick to the bottom of the wick. Now, the body of the chart is key because this bottom left on a green candle represents where the price opened for this time period. And the top right of the green candle will tell you where the price closed for that time period. You can apply the same thing to the red charts. Now, the red charts means price moved down. The left top bar will represent the opening price, and the bottom right corner will represent the closing price. So those are a couple key things to keep in mind when it comes to price charts. Now, let me go into a couple examples of price charts with these charts right here. Now, here we're looking at a chart of Ethereum versus the US dollar, and these candles represent 15 minutes of time, and this is on the Coinbase exchange. And the first thing you'll notice is that candlesticks come in many shapes and sizes. Here's a big down candlestick in red. Here's an up candlestick in green. Here's one that's all wicks right here. But one key type and behavior I want to point out is known as the bearish engulfing candle. Now this happens when the price of the new candle goes higher than the price of the previous candle and then closes below the low of the previous candle. So this is a bearish engulfing pattern, and it usually signifies that prices are going lower. And the reason for this is you have to put yourself in the shoes of the other market participants or the investors. Let's say you were an investor that bought this green candle here expecting price to go higher. Now all of a sudden, this big seller walks into the market and knocks the price down lower. So if you had bought here on the expectations that prices would continue trending higher, now you're looking at more sellers, and so that's bringing out more people who are selling because now prices have reversed. On the flip side, we have the bullish engulfing candle. Now this is a chart of Bitcoin versus the US dollar. Each of these bars represents 240 minutes, which means 4 hours of time, and this is on the Coinbase exchange. Now a bullish engulfing candle is similar to a bearish engulfing candle, but it signifies that prices are ready or perhaps might be moving up. So right here you have a red candle, and the next one, this bullish engulfing candle, actually drops below the price of the preceding candle and then closes above it. So it closes up here. And this signifies to other market participants and other traders that prices might be rising. And just as you're looking at, prices did rise over time. They went up. This candle closed at 6,000, and then by the next day, prices were at 6,700. So these are two simple ways to use candles to identify changes in price. Now, when you're trying to figure out what type of chart you should use, you need to keep in mind that there are different types of scales. Now, the first type of scale is known as linear, and this is the most common chart form. And what this means is that the price axis and the time axis are on equal plots. The second type of chart that you want to use in the crypto markets is known as the semi-logarithmic. And what this does is it's going to show you a percent price change that's the same all the way up on the y-axis, and I'll demonstrate that in a second. The rule of thumb that I use for crypto markets is if there's a price that moves over 100%, I want to use a semi-log chart to identify that price. And let's take a couple look at a few charts to see how this works in practice. Right here, you're looking at a Bitcoin chart. This is Bitcoin on the Bitfinex. And you'll notice this is not a candlestick chart right now. This is actually an area chart. So the area chart is basically a line chart with a shaded area below it. And this is a good way of illustrating a longer-term chart trend. It starts in 2015, and you can see this is about 3 years worth of data. And most noticeably on this chart is that the y-axis moves up in a linear fashion. Okay, so from 0 to 2,000 to 4,000, all these numbers jump in the same arithmetic formula. Now, you'll also notice that in 2017, prices look like they skyrocketed in Bitcoin. I mean, the market started rallying throughout the first half of 2017, and then they really took off. And that's true, prices did jump. But if you think about things on more of a semi-log area, this rally is no different than ones we've had in the past. In fact, not much different than ones we've had in the last few years. So a semi-log chart on the y-axis gives us a percent change in prices. So if you start here at 210 and move up to, let's say, 420, which would double it, it's equivalent from moving from 2100 to 4200 on the same graph. You can see the distances are roughly the same amount. And this will show us that Bitcoin, even though the move has looked parabolic on an arithmetic chart, it's not much different than the trend has been since all the way in 2015. So it doesn't look as dramatic on a semi-log scale as it does with an arithmetic chart. And it's important to look at these semi-log charts because they'll notify you and show you that these trends tend to be the same over time. Even though something might look parabolic, it's happened in the past and probably will happen in the future. Now, when you think about technical analysis, it's going to show you a chart and the price trends in that chart of the asset. But you also have to think about technical analysis as understanding the behavior of the market participants. Now, we've seen over different market cycles and asset classes that charts and prices are determined by people's beliefs. And humans have the same greeds and fears no matter what the asset class is. Whether you're trading the stock market or the crypto market, those fears and greeds will always be the same. So over time, we've used technical analysis to give us not so much a prediction, but more information as to where prices might be heading next. So there's a couple simple chart patterns that I want you to know about. And I'm going to start by the double top and the double bottom. Now, in a double top, a price has been reached, then the price drops, hits that same price again, and falls. That's a double top. The double bottom is just the reverse of it. The next simple chart pattern is the head and shoulders reversal. And this happens when prices reach a new high, they drop, and then they fail to break that previous high. So it looks like a head and shoulders. And I'll show you what that chart looks like in a second. And lastly, you've got the rounding bottoms. Now this chart is an accumulation period. And it's usually when there are buyers moving into the market that aren't letting the price decline. And it usually turns into a big bull move in the chart. Now, let me look at a couple of these charts to show you an example of what I'm talking about. The first chart we're looking at here is a chart of Bitcoin versus the dollar. It's a 15-minute price chart on the Bitfinex exchange. Remember, each of these candles here represents 15 minutes in time. And what you'll notice is that in this short-term period, prices sold off and hit a double bottom. The price of Bitcoin dropped below 9,300 right here. It rallied and then sold off and hit a double bottom. So anyone who's trading this noticed that the downtrend looks like it was reversing. So they came in and bought and pushed the price higher. That's indicative of a double bottom. Now, a double top is exactly the opposite. And this is, again, a 15-minute chart of Bitcoin versus the dollar on the Bitfinex exchange. So in this case, the price of Bitcoin rallied to 10,500, then it sold off, and then bounced back to 10,500, forming a double top. And then immediately after that, you had a huge drop and a downtrend. And so that's a double top. Next, we've got a head and shoulders. And this one has been pretty predictive in the Bitcoin markets. And there's a couple things in head and shoulders that I want you to notice. First, when Bitcoin breaks to a new high up here, this is considered the head. Now, as it sold off and it bounced again, it formed this pattern that looks like a shoulder. That's why we call it a head and shoulders. Here's the head, and here's the shoulder. Now, the key level here is the neckline. And the neckline starts from the first bounce. So when Bitcoin bounced at 12,774, it formed the neckline. And you'll see once this neckline was finally broken, prices dropped very rapidly. So this is a $3,000 drop in Bitcoin. And then it bounced. But what's key about this chart is that what once was support at this neckline then turns into resistance. So you can see there was a battle going on here with the buyers and sellers. So this was support during the neckline, but once it was broken, it became resistance. Prices were unable to get above 12,774. Another chart of Ethereum head and shoulders. This is Ethereum versus the US dollar. You've got a one-day time frame for each candle. And this is on the Coinbase exchange. And this is the head, and this is the shoulder. And you can see prices drop down here to this neckline. Same thing that we saw in the Bitcoin chart, where when prices finally dropped below the neckline, there was a big flush followed by a rally. However, this area here at 983, which was once support, now becomes resistance. So people who were once buying at this point are trying to sell because they were buying at support, accumulated Ethereum, and now they have some to sell at the same price. So that is a classic head and shoulders pattern. Now lastly, I want to show you what a rounding bottom looks like. Rounding bottom is indicative of prices moving higher. And you can see there's a little bit of a curve to this as it's trending higher. And what we've seen with rounding bottoms is when they finally break to a new high past the old high. So the old high here happened in June of 2017, when the new high in this Bitcoin versus dollar was finally broken in December. you saw what's known as a parabolic move. So as soon as the previous high was broken, then buyers quickly rushed into this market and sent the price higher. So those are just a couple simple price charts that you need to be familiar with when you're looking to analyze the crypto markets. Remember, in crypto markets, as in any markets, the trend is always your friend. You need to determine which direction prices are moving in order to put in appropriate buy and sell orders. Now, mistakes will be made when buying and selling, but it's professionals and better traders are able to quickly correct those mistakes in order to profit in the long run. So let's begin by talking about a couple moving averages. And what are they? Basically, they help you identify which direction the market is moving. The first consideration is what time period should you choose? Now, I prefer using the time period that are chosen by most market participants because then I know everyone's looking at the same signal. And in this case, I'll use a 20 period, a 50 period, and a 200 period moving average. The second consideration is moving average convergence divergence. And what does that mean? And basically, these moving averages tend to move away from each other or move closer to each other over time. And you'll see sometimes when they cross, that can give us a buy or sell signal. So let's look at some charts right now and get into it. So here's a chart of Bitcoin versus the US dollar. Each candlestick represents 1 day's worth of data, and this is on the Coinbase exchange. Now you'll notice not only do I have these candlesticks, but there's these squiggly lines as well. And what these are represent exponential moving averages, and that's what the EMA stands for. Now, I like using the exponential moving average because it gives a higher weight to prices that are closer to that specific candle. And in this case, I've chosen 3 different time frames. The blue line is the 20-day EMA, the orange line is the 50-day EMA, and the pink line is the 200-day EMA. Now, in an uptrend, these moving averages can give us an indication of where support is. So once this price trend is above this moving average, if it pulls back to the 20-day, that can be a weak support. If it pulls back to the 50-day, this can be stronger support. And then the 200-day moving average should serve as the strongest level of support. What you'll notice about moving averages is even though I'm applying them here to a 1 day's time frame, you can use them in shorter time intervals as well. Now, this chart is Bitcoin versus the dollar in 240 minutes, so this represents 4 hours of time per candlestick, and this is on the Coinbase exchange. And here I've identified the 20-period exponential moving average and the 50-period exponential moving average, the 50 and the 20-day. And what I want to show you here is that at one point in this price history, the 20-day time period crossed over the 50-day time period. So the blue line essentially moved below the 50 period. And when this happens, it signifies the price trend has changed. So if you were to sell Bitcoin here at, let's say, a price of 15,000, you'll notice that once this price moving average, the 20 period went below the 50 period, the prices continued lower for a considerable amount of time. In fact, the price didn't really bottom until 6,000. So Bitcoin went from 15,000 to 6,000 on this. I also want you to notice that if you're selling short Bitcoin, which means you're profiting as it's going down, the best times to buy are when these moving averages really diverge from one another. So when the 20-period moving average diverged, see this difference in these 2 lines right here? This was a good place to take profits. Same thing at 6,000. When you see a big divergence in these moving averages, if you're short, you want to take profits. On the flip side, you can see the uptrend has started to resume a little bit lately because the 20-period moving average, remember the blue line, crossed back above the 50-period moving average. So now this is signifying that prices are trending higher. Now another chart of Bitcoin versus the US dollar on a 15-minute time interval, I just want to show you how these same exponential moving averages can be applied to daily charts, to 4-hour charts, and also 15-minute charts. Same thing here. You see this cross where the 20-period moving average drops below the 50, and this signifies that the trend has changed. So the trend was moving up as the blue line was above the yellow line, and then it crossed over and prices dropped significantly. The price here on Bitcoin when this cross happened was about $11,500 500, and then it dropped all the way down to about 10,000. So you saw about a 15% drop in just a couple of days. Here's a chart of Ethereum versus the US dollar, and this is a one-day time frame. So each candlestick, remember, represents 1 day of price changes. This is on the Coinbase exchange. Now I've signified the different moving averages, the 20-period moving average, the 50, and the 200 exponential moving averages. And you also notice here how the 20-period during this uptrend served as support for Ethereum. So each time Ethereum sold off, it touched this exponential, this 20-period moving average and bounced higher. The few times that it dropped below to the 200-period moving average, now these are great times to buy in this uptrend because you had a price drop that fell from 500 here to about 200 here, so it dropped more than 50% and then rebounded back to 400 or 500. Same thing in this price drop, the 200-period moving average. It dropped all the way down to 200 and then bounced back, and then Ethereum took off and rallied up to 1,400. Now just keep in mind, these not necessarily are these predictive, but they're just really informative. They're just a way for you to analyze the market and think about where are places that you should buy and sell these different crypto assets. Here's another chart of Ethereum versus the US dollar. Again, it's a one-day candle formation on Coinbase. I've identified these three different exponential moving averages, the 20, the 50, and the 200. And what we're looking at here is just a closer look at the times Ethereum dropped to this 200-period moving average, which signified strong support. In fact, there are only 3 times during this time frame, so in 6 months, that Ethereum dropped the 200-period moving average. And each of those times, you saw a significant bounce in Ethereum. So it bounced right off that 200-period moving average every single time. Here's another chart of Ethereum versus the US dollar. Now 240 means 240 minutes, or about 4 hours. And this is on the Coinbase exchange. And I'm looking at here 20-period exponential moving average versus 50, and I've got a bunch of crosses here going on. I've got a cross of the 20 above the 50 here at a price level about 750, which took Ethereum up to a price level of 1,400, so you saw a double. Again, you see how this moving average started in a tight range, but then it diverged. And once these prices start to diverge and they get really wide, this is indicative of a place you want to hit the sell button if you're long. On the flip side, the price drop happened and the 20-period moving average dropped below the 50, and this move in Ethereum continued for a couple weeks here, where it was weaker because the 20-period was below the 50-period, which is indicative of a downtrend. You saw a really sharp cross here in early February where the 20-period moved below the 50-period. Remember, the 20-period is the blue, 50 is the orange. Prices dropped significantly, and you saw the price of Ethereum versus the dollar drop from 1,100 all the way down to 550. So you're looking at a 50% price drop as that moving average crossed. And more recently, you've seen the moving average kind of turn higher and then back down again. So the last chart here is Ethereum versus the US dollar, and this is the 15-minute price chart. So this is shorter time frames, but you'll see that these crosses on these exponential moving averages still hold up over different time frames. So you can apply this technique not only to your daily charts, but also something really short if you want to be a day trader or trade the prices in the real short term. You've got a cross here at 970, which took the price back down to 910 in the same day. And if you were trading this divergence here and you had shorted Ethereum, now this is where you want to start buying back when the price trend of the 20-period average diverges from the 50. And you saw another one of these divergences or crossovers happen right here at 950, and then prices of Ethereum dropped all the way down to 820. So this happened in just a few hours. So there you have it. You can see how these moving averages and their convergence and divergence and crossovers can be applied not just to daily charts, but many different time frames. And always remember that technical analysis is not predictive, but it's informative. So after you've determined the trend in the crypto markets, the next thing to do is to understand whether that trend will continue or it will reverse. And there's some indicators you can follow that can help you with this. The first one I want to get into is the relative strength index. Now, the relative strength index is a momentum oscillator. It basically measures the health of the market, specifically the health of the rally or the health of the sell-off. It's calculated on an index between 0 and 100. And between these numbers, there's some key readings. So a reading below 30 is considered oversold, and a reading above 70 is considered overbought. Now, let's get into a few charts to help us determine this. So what you're looking at here is a chart of Bitcoin versus the US dollar, and each candle represents 1 day of price. And this is on the Coinbase exchange. Now, I first want to point out that I've labeled the exponential moving averages, the 20-day and the 50-day. So when you look at the RSI, here it is below. You can see it bounces above this pink area. And now the pink area right here is calibrated to 70 and 30. So those are the key readings that I mentioned just a second ago. 70 means overbought, 30 is oversold. Now, one thing to know about the RSI is it just calculates what the market is doing, and when it doesn't follow the market, it offers actually a more powerful signal. And what this is called is divergence. So you want to look where there's a divergence between the RSI and the underlying asset. And in this case, I'll break this down. So if we're looking at a price trend that's going higher, and right here you have the 20-day above the 50-day, so things are great, things are bullish. And then you'll notice at this peak right here, the RSI hits a level above 90. Now, prices retreated and then went to a new high right here at about 20,000 of Bitcoin. And this is one of the most powerful signals we've seen in Bitcoin in the last few years. Even though the prices went higher than the prior peak, the RSI actually diverged. The price reading was lower than the previous price reading on the RSI. And what this tells me is that the trend is in trouble because there is not as much bullish sentiment as there was at the previous price high. And what happened after that? The price of Bitcoin dropped about 60%. So what you're looking at here is a chart of Ethereum versus the US dollar, and the time frame is different. So these are 240-minute candles, which represent about 4 hours. This is on the Coinbase exchange. Now, the same thing. In this case, the price of Ethereum was dropping, right? However, at this low right here, there was a divergence between the RSI. The RSI dropped to a reading of about 15, and then at this drop, which the price was lower, the RSI was actually slightly higher. So typically, when you're seeing a sell-off, you want to see lower readings on the RSI to know that that sell-off is going to continue. If the price or the point of the RSI diverges from the price, this is a signal that prices have typically bottomed out. And what we saw after this was the price of Ethereum went from about 570 all the way up to 900. Next, here's a chart of Bitcoin Cash versus the dollar, and this is charted on a 1-day time frame on the Bitfinex. Now, the exponential moving average, the 20 period, and the 50 period are labeled in green and blue. And now you'll see in this one is that you had a significant parabolic high in Bitcoin Cash. However, this RSI was lower than the previous one, which is actually a lower high. So the RSI actually went down as prices went up. So this is known as a bearish divergence. And this is telling you that prices likely will not continue higher because the RSI is not matching where the price is going. And in fact, the price of Bitcoin Cash dropped over the next couple of months. And it's also noticeable that these signals don't occur very often, but when they do, they give us places to put stop losses or sell orders. Next chart is XMR versus the US dollar. Now, this is a different cryptocurrency. This is Monero, which is an anonymous form of cryptocurrency. And this is a 1-day chart on the Kraken exchange. And in this case, we saw the price hit a new high above 440 in December with an RSI reading up above 90. And the next time the price went to break out above that high, it failed, and the RSI was way lower. So this goes to show you that there wasn't as much bullish momentum during this rally as there was at this one. And what happened? The prices went on and dropped about 50% in the next month. So in this chart, you're not looking at the price of a cryptocurrency against a dollar. You're looking at the price of a cryptocurrency versus another crypto. And in this case, you've got Ethereum versus Bitcoin. Each of these candles represents 1 day in price moves, and this is on the Bittrex exchange. Now again, I've labeled the EMA 20 period and the EMA 50 period, with the orange being the 50 and the blue being the 20-day. And what you'll notice here is that the relationship between Ethereum and Bitcoin dropped here in mid-December. But that didn't coincide with a lower low in the RSI. You actually had a bullish divergence here. The RSI hit about 22 at this point on the drop right here in October. However, then in December, prices fell, but the RSI didn't follow. It bottomed at actually a higher low. And so this gave us a bullish divergence and led to a higher price climb over time. So there you have it. And just a reminder, no system or strategy is perfect, but the RSI is an indicator that gives us some sound levels where to buy and sell different cryptocurrencies. Cryptocurrency markets are historically volatile. These are speculative investments that carry a high degree of risk. Now, you may have heard of the huge price rises in Bitcoin, Ethereum, Litecoin, and other altcoins in the last year. In fact, it was common to have price moves of 1,000%, 2,000%, even 10,000% in some cases. However, new investors don't consider that what goes up also comes down just as volatile. For instance, in 2017, Bitcoin rallied 1,400%, but during that time, there were 7 price drops of 20% or more. And so a new investor that moves into the space makes a common mistake of position sizing too big without considering how volatile this asset is. So let's give you a quick rundown of how to think about trading in a volatile market. Now, the indicator I like to use is called the average true range, or ATR. And what this is basically just an average of how much the price has moved over a specified period of time. If you think about ATR, you can use it as a risk framework for where to set your buy orders and your sell orders and also your buy stops. So let's take a look at a chart right now and show you how this works. So what we're looking at right here is a chart of Bitcoin versus the US dollar. These are 240-minute candles, which represents 4 hours of time. This is on the Coinbase exchange. Now, the first thing you'll notice is that the top chart looks just the same as every chart we've looked at so far. Now, below it is a chart of the average true range. And this average true range gives us the range in volatility of the past 14 time periods. So you can apply this 14 time periods to days if you're looking at a daily chart, or for here, these will be the last 14 4-hour periods. Now, average true range is not a static indicator. You can see how it moves up and down, especially when the market's really volatile. So with this sell-off in Bitcoin, we saw the average true range rise to about $700. When the Bitcoin markets are less volatile, the average true range sinks between 300 and 400. Now, these numbers are important because they'll give you an indication of how much volatility you can expect in the price of Bitcoin over a given period of time. So if you were to buy Bitcoin at, let's say, 6,000 here, the average candle, you should expect a 700-point move. So if you're buying something at 6,000, then you should expect that this could potentially drop to 5,300 in the next 4 hours. And so when you're setting stops or putting buy orders in or sell orders, you have to be aware of how volatile the asset is, and the average true range gives you this framework. So in further lessons, we'll show you how to set stops and sell orders using this average true range framework. You may be familiar with buying a cryptocurrency and profiting when the value goes up. But did you know you could also short a cryptocurrency and profit when the value goes down? So what exactly is shorting? Shorting is the ability to borrow a crypto asset, sell it, and then buy it back at a lower price. You never really own it, you've just borrowed it, and so that gives you the ability to buy it back lower. For instance, if you borrow Bitcoin and you sell it at, let's say, 10,000, and the value of Bitcoin drops to $5,000, you've just made $5,000 in profit. And this is key because prices tend to drop faster than they raise. Now, how exactly would you short Bitcoin? First, you have to locate an exchange that you can trade on margin, because on exchanges that you can trade on margin, they allow you to borrow Bitcoin. So the next thing to do is you just borrow Bitcoin and then sell it. And that's what shorting is. So let's take a look at a chart to break down shorting for you. Now you're looking at Bitcoin versus the dollar on a 240-minute time frame on the Bitfinex exchange. And now what you need to do is borrow Bitcoin and sell it and collect for a profit when you buy it back. If you were to sell Bitcoin when this moving average crosses, when the 20-period moving average crosses below the 50, right here at 11,000, and buy back here at 6,000, you would collect a $5,000 profit. So this goes to show that you can not only profit when prices go up, but it's possible to profit when prices go down. So that concludes section 5. Now just to review, you should be able to develop a strategic trading process in the crypto markets. You should also be able to overcome some of your biases and limitations. And you should be able to explain why holding on for dear life is just not a viable strategy. Additionally, you should now be able to identify trends using price and time. You should be able to summarize why the trend is always your friend. And finally, you should be able to draw trend lines. You might think that being able to identify the trend, when to enter and exit, are the most important aspects to know how to capitalize in the crypto markets. While these are important, arguably the single most critical thing to know is how to properly manage your money and investments. At the end of this section, you'll be able to apply proper techniques to an extremely volatile market and demonstrate proper risk per trade strategies. So when it comes to managing your crypto investments, I'd like to highlight a few tips or mantras for you to think about as you move into these markets. Now first is prepare to be wrong often. The crypto markets and any market will make even the most brilliant investor look foolish at some point. So understand that you're going to be wrong and figure out how you're going to deal with being wrong. Next, you always want to have a plan. You want to design some type of framework that gives you a maximum reward with a minimum amount of risk. Next, discipline over conviction. And what I mean by discipline over conviction is you might have conviction that the price of Bitcoin is going to go to 20,000 or 50,000 or even 100,000. However, if the price isn't following your conviction, then you need to have discipline and understand where you might be going wrong. And lastly, you need to be able to sell when you can and not when you have to. The crypto markets are extremely volatile. They offer a lot of opportunity for profit. They also offer a lot of opportunity for loss. So the key is to be able to sell, even if it's just a portion of your holdings, when the prices move up dramatically, so you don't have to sell when they plunge. Remember, crypto is a brand new asset class. It might trade like penny stocks, but it's not stocks. It might look like the Forex market, but it's not the Forex market. Let me quickly touch upon two risks to the crypto space. One, capital loss. These assets are extremely risky. They've been known to pull back 80%, 90% sometimes. So you have to understand, if you're sitting on a loss, it might make sense to get out of it and move on to the next trade. And one more risk is asset loss. And this is specifically endogenous to crypto because if you don't properly secure your private keys, you're at risk at losing your entire asset. You can't really do this in the stock market. Nobody can break into your TD Ameritrade or E-Trade account and steal your stocks. However, in crypto, if you don't secure your private keys, you can lose your entire investment. So keep these two risks in mind when you're moving into these markets. When you're buying or selling crypto assets, there are some catalysts you might keep in mind that will drive prices up or down. Now, some of these are specific to crypto, but others happen in other asset classes as well. So the first one I want to point out is added to a larger exchange. Now, We saw in December of 2017, Bitcoin Cash was added to the Coinbase exchange, and the price of Bitcoin Cash went up 200, 300% in just a day. So there became a trade where other market participants were trying to predict what would be the next asset that's added to Coinbase. Next, corporate partnerships. And this is going to be large in the years ahead. If some of these cryptos start linking up with major corporations such as Microsoft, Google, or Amazon, this is something that can drive the price up. Now, crypto is trying to decentralize everything, so the idea that they're going to link up with corporate partnerships might raise skepticism with Bitcoin maximalists. Another catalyst is forks. What a fork is if you own the specific coin and the blockchain forks, you receive an equal amount of coin in the next fork. So if you own Bitcoin going to the Bitcoin Cash fork, let's say you had 5 Bitcoin, you receive 5 Bitcoin Cash when the protocol forked. Another catalyst, government crackdown. And we've seen over the years that governments are trying to regulate cryptocurrencies. For instance, in China, it just seems to be a cat and mouse game where the government comes, shuts down exchanges, and the price of Bitcoin sells off. And then they say, we didn't want to shut them down, or they allow for more trading, and the price goes up again. So keep an eye on regulations, especially now in the United States, as the SEC and the FINRA start thinking about how they regulate these crypto assets. And lastly, FUD. Now that stands for fear, uncertainty, and doubt. And this is a general malaise that happens when the Bitcoin markets have a significant pullback. This is a tone that just seems to be in the air that doesn't allow prices to go up. So these are important catalysts to think about when you're moving into these markets. There's been a lot of talk of where crypto assets fit in a portfolio. Now, we've been told to own a blended portfolio of uncorrelated assets. You want to own some stocks, some bonds, and some commodities. So where then would crypto fit in this portfolio? Well, to be sure, we're not entirely positive that crypto is an uncorrelated asset class. I don't think there's enough data to suggest that its price doesn't specifically rely on anything just yet. The asset class is so new. But then if you decide you want to own some crypto in the portfolio, here are some questions you might want to ask yourself. The first is, how much should you invest? Now, like we saw in a previous lecture, crypto is extremely risky. Not only do you have risk of capital loss, but you have risk of asset loss as well. Someone could hack into your mobile phone, steal your private keys, and your investment is totally wiped out. So consider that when you're moving into these markets. The second question is, how should you allocate these funds? Now, I think about how I can capitalize on growth in the space, and what that means is I want to own the majors, the crypto reserves, Bitcoin, Bitcoin Cash, Litecoin, and Ethereum, but I also want to blend them with a portfolio of altcoins that are moving up. So I look at that as like a 50-50 blend to capitalize on growth of the entire space in the future. When you're thinking about how much you should invest on any crypto trade, you should consider this. There's a famous book called Market Wizards, and in an interview with a trader named Tom Bassow, he stated that he never risked more than 3% of his equity on any given trade. So think about that when you're moving to the crypto markets, where these assets can move by 10%, 20%, even 40% in a single day. Now, risk per trade strategies are a key determinant of whether you'll reach your financial objectives or ruin. And the one position strategy that I like to use is called the percent risk model. And this gives me an indication of how much equity I stand to lose if the trade goes against me. So if you buy Bitcoin at, let's say, $10,000 and you have a $9,000 stop, I'll make sure that I only invest in as much that I'll know how much percent of my equity I'll lose if I get stopped out of the trade. So that concludes our section on money management. Now you should be able to apply proper techniques to an extremely volatile crypto market, and you should also be able to demonstrate proper risk per trade strategies. Money management, risk per trade, trading strategies, you know them all. What's next? Knowing when and how to enter the market. Now at the end of this section, you'll be able to select entry points based on technical analysis and identify support levels using Fibonacci retracements. There are many methods of analyzing the crypto markets. And as we've seen in a previous lesson, crypto assets have very high speculative value or extrinsic value and very low real-world value or intrinsic value. Now, technical analysis can give us an indication of where to buy and where to sell. But I want to caution, technical indicators aren't purely predictive. However, they give us an information or a roadmap as to where to purchase and sell crypto assets. Now, I like to keep my technical indicators very simple. And the reason for this is because you want to look at what most market participants are looking at, because markets are reflexive. If everyone's looking at the same information and acting on it, some of these charts can become self-fulfilling. Now, some of the key entry strategies I like to use are channel breakouts. And this happens when a trend, which is either going up or down, starts to accelerate one way or another. Moving average crossovers. And this can indicate a change in direction of the trend. And lastly, we'll look at Fibonacci retracements. And these are great for figuring out what support levels to buy at when the market pulls back. So let's get into some of these charts right now. So let's first start by looking at a long-term primary trend. Now, this is a chart of Bitcoin versus the dollar. Each of these candles represents 1 week of trading, and this is on the Bitstamp exchange, one of the original Bitcoin trading exchanges. And I'm looking at a log chart here, and I explained this in a previous lesson. You can call it log or semi-log, it's the same thing. And what this represents is that on the y-axis for price, each move is via a percent increase. So the move from 2 to 6 should be the same as the move from 200 to 600, the same distance at least. Now, I drew a long-term trend line here that shows that the move in Bitcoin for the last 6 years has been steadily higher. However, within this long-term trend line, there's been significant pullbacks, and Bitcoin has had some pretty big bear markets that have resulted in going back to this long-term trend line. So if you're thinking about Bitcoin as a long-term investor, you might want to consider buying at these support levels here when Bitcoin eventually goes back to this long-term trend line. And the reason for this is that buyers who have been successful buying on this long-term trend line will likely repeat that behavior again in the future. When you're considering entering the crypto markets, I want to discuss an indicator that offers levels of support that traders use to buy or establish a new position. Now, Fibonacci retracements are based on the Fibonacci ratio. And in mathematics, this is known as the golden ratio. It's seen in biology and also in architecture. What you do with Fibonacci retracements is you pair a recent trough and a peak. And you divide this distance by the key Fibonacci ratios of 23.6, 38.2%, 50%, 61.8%, and 100%. And these give you key levels of support. Now, I'm going to show you how to draw these Fibonacci ratios, and let's go over some charts to outline that right now. Now, the first Fibonacci retracement chart we're going to look at is a chart of Bitcoin versus the US dollar. It's a daily chart, and the exchange is Coinbase. Now, this is a chart of when Bitcoin reached its peak of 20,000 in December of 2017. And I want to just show you how well these Fibonacci retracements held. The first level of 38.2%, this pullback, held as kind of a short-term support on the drop. And then at 50%, there was actually stronger support, which resulted in a almost 40% rally after that Fibonacci retracement level held. However, if you look at this chart of Bitcoin, you'll notice another pattern that's going on here. You've got your classic head and shoulders pattern, and then once this neckline was violated right here, there was more sell-off that occurred. So this chart of Bitcoin retraced all the way, almost all the way to its 100% level. And then on the way up, these Fibonacci retracements, which once were support, are now resistance. So this level here, which held as support at 61.8% at about 10,800, then became an area of resistance. So you'll note that not only do these Fibonacci retracement levels work on the downside, but also on the upside as well. They serve as kind of a resistance point. Now, I'm asked the question, why do these Fibonacci retracements seem to work? They just sound like magic numbers. And
The truth is they work because people believe they work, and so it becomes self-fulfilling. So look at this chart of Ethereum versus the US dollar. It's a daily chart. It's on Coinbase. This is a similar time period to when Bitcoin hit its $20,000 high and pulled back. This is early 2018. You'll notice that Ethereum peaked at around 1,400 and then dropped to about this 50% retracement level on the Fibonacci numbers before bouncing, but then the 23.6% ratio acted as almost as a resistance level. Again, this is a classic head and shoulders chart where the head happened at 1,400, you had a right shoulder around the $1,200 level, and then the neckline, which was once support, was quickly broken, and that led to lower prices. So on this chart of Ethereum, what I'm looking at is a 100% retracement from the highs in Ethereum. Remember, support then turns into resistance in the future. So this price level right here at 983 then became resistance when Ethereum bounced off the low. And I want you to consider that, and the reasons for this is that people who had been buying at this support level are now breaking even when it gets back to this price. So in order for them to break even on the trade, they have to become sellers, and that creates a resistance level here in Ethereum. So I'd like to illustrate that not only do these patterns hold for Bitcoin and Ethereum, but they hold for other altcoins as well. And you can basically apply them to any crypto asset you're trying to analyze where to buy and what's a good entry point. So this is a chart of NEO versus the dollar. Again, it's a one-day candlestick. This is kind of the 30,000-foot view. If you want to zero in closer, you choose a 4-hour or maybe a 15-minute time frame, but I like to take the long view. And this is on the Bitfinex exchange. Now, this was the swing low here at NEO, and I paired it with the swing high here at about $198. And you'll notice this chart looks similar to Ethereum and Bitcoin, the two we just reviewed. You've got a head here, a shoulders here, and support happened at this 50% retracement level. Now what's interesting about this is you've got a classic head and shoulders pattern again, followed by a violation of the neckline at this price. Then NEO saw resistance at that same price at the 50% retracement level, but once it broke above that 50% retracement level, the resistance point here then became support again. So you'll notice when you're trading and you're investing in crypto assets, how these levels are key because they swing between a place where you want to buy the crypto asset and a place where you want to sell the crypto asset. So this level on NEO, this 50% retracement from the early January highs, is now becoming a support level. And so if you're a buyer of this, this is the level that, or the price level you want to buy it at. Now let's look at some moving average crossovers, which can also serve as entry points. Now the first chart we're looking at here is a chart of Bitcoin versus the dollar, and each candle represents 240 minutes or 4 hours of time. This is on the Bitfinex exchange. Now I've drawn two exponential moving averages already on this chart, the 20-day and the 50-day. The 50-day is in yellow and the 20-day is in blue. Now the key levels here are when the 20-day moving average crosses below or above the 50-day. So you've got a cross right here where the trend shifts, and this signifies a time that you should be selling whatever crypto asset you're looking at. And in fact, once this moving average crossed, you saw a 40% or almost 50% pullback in Bitcoin till the bottom. Now I've said this before, when these moving averages diverge, if you're in a position, this is time to get out. You don't want to wait until the moving average crosses over again at this point. I think if you have a huge divergence between the moving averages, that means that the short term is extended, which happened down here. So when the moving averages are this wide, it's time to take a profit if you're short. Now on the flip side, if you want to buy, you want to do it when the 20-period moving averages crosses above the 50-period moving averages. And I've signified this with this arrow right here. So this happened at a price level about 8,600 on Bitcoin, and it carried it to about 12,000. So if you were doing this trade, it's about a 30 or 40% return in just a very short period of time. And one of the reasons why it's important to wait until the trend changes is because you might get some false signals down here that the trend has changed. And I think in trading it's important to think between the 30-yard lines. You don't always want to have to play between the 100-yard line on one end and the 100 on the other end. The highest probability trades are going to occur just in between the 30-yard line. So this is a good illustration of that. Now the next chart, another moving average, is Bitcoin versus the dollar. It's a daily chart on Bitfinex, and this goes all the way back 1 year time. So on this side of the chart, we're looking at March of 2017. And the first thing you'll notice is that Bitcoin had an incredible move last year. And listen, anyone who bought Bitcoin in the last year and held on looks like a genius because the chart just went up and up and up. We've gone through one of the greatest bull markets of all time. But if you're just following this trend trading strategy and buying when the moving average actually crossed over, that would have gotten you long down here in Bitcoin, which is below 1,000, and would have told you to sell when it crossed over on the other side, which is 13,000. So you're looking at a 1,300% move when the trend was never violated. So if you're thinking about a long-term strategy and using moving averages, you might want to consider using these moving average crossovers. Now, I'm going to talk about channel breakouts. And this is a more controversial way to trade. But you'll notice in markets, when they trend, they usually remain in a channel. So I'm looking at the exact same chart of Bitcoin, a 1 year chart. Remember, Bitcoin versus the dollar, a daily chart on the Bitfinex. And this goes back to March 2017, and we're right here in March 2018. And you'll notice that for most of 2017, Bitcoin remained in this channel. Even though there was volatility between the channel when you could have made short-term trades, whenever prices dropped to the bottom of this channel, they held. Now, something happened in late November of 2017 when the trend actually changed. It accelerated. So you can see this trend breakout that occurred right here when prices went higher. So if you had been watching Bitcoin from the sidelines and said, I'm just going to wait until the trend changes, I'm going to buy a channel breakout, you would have not bought at any of these prices. And thankfully, because in the short term, you could have lost 20 to 30%. Remember, Bitcoin had 7 pullbacks of over 20% in 2017. However, this would have gotten you long here close to the high. So this is one strategy, the channel breakout, I don't necessarily recommend, but it gives me a good indication that when the trend changes, it's as if the behavior of the market has shifted, because people not only wanted to get long Bitcoin, they had a fear of missing out, so they were willing to buy at any price. So when the trend like this in the channel gets violated, you can see that the behavior is starting to shift. Now, another chart is Ethereum versus the US dollar, 1 day on Coinbase. And I want to show some of these channels that exist in Ethereum that differ greatly from the way Bitcoin trades. Now, Ethereum has these kind of step moves on it, whereas Bitcoin had a long-term trend. So this is a different way of trading a market, but you have to kind of follow what the patterns of what the market's giving you. So Ethereum would move to a certain price level. Right here in this little channel, it moved to the 41 to 54 range, and then it would step up in just a short period of time to another higher range. Same thing happened here, a step up, and then it found this range between 160 and 210, and then you had a step to another, and then kind of sideways action for most of the summer. But then the same pattern continued, where Ethereum would break out of this longer-term sideways channel and break higher. So you can use these channel breakouts in markets that are moving sideways, but I wouldn't suggest using them in markets that are trending higher. I think when you have a trending higher market like you do in this chart of Bitcoin, and the channel gets broken, it usually signifies that there's a short-term or medium-term top that's about to occur. So while our previous chart of Ethereum was a log chart, let's look at a linear chart right now. And this is Ethereum versus US dollar daily chart on Coinbase. And you'll see that the moves on the linear chart are much more dramatic than the ones on the log chart. Case in point, if you look at some of these ranges right here, Ethereum stayed between 4 and 500. And it had initially tried to move higher, but that acted as a resistance point at 500. Now, when Ethereum came back and broke 500, this is a signal to get long, because once it breaks out of this channel, there is no resistance until the market decides there's going to be resistance. And when you have an asset that's highly speculative and there's no real way to assign real-world value to it, people just tend to buy because they fear they're going to miss something. And this is really what's been happening with Ethereum over the last year. You just have a lot of people that have the fear of missing out on the next big thing or the next Bitcoin. And you'll see this with a lot of crypto assets that come out of nowhere, and this is responsible for 5,000%, 10,000% gains in a short period of time, because there's only a very limited supply of these crypto assets, but you have the whole world really trying to buy the same assets at the same time. So Ethereum here had a little range after this breakout, and it stayed in that range, and then all the moves in Ethereum happened just in a very short period of time. So each of these breakouts and these moves up happen in just a couple days. Most of the time, the market kind of stays sideways and doesn't really move up or down. And the key is to understand where is the most effective point that you can buy and be involved in the market for the move, and then get out of it when it looks like the move has expired. So you can use these different entry strategies, such as channel breakouts and moving averages, to find those points. Now let's look at a chart of Litecoin to show you a huge channel breakout. And you'll notice in this Litecoin chart, there was a range that Litecoin traded in for most of the summer between 50 and 100. So 100 here acted as resistance, whereas 50 was support. And for a while, Litecoin was just kind of bouncing around the support level. But then when it got to 100 again, something changed dramatically. There was a huge rise in volume, and this breakout signaled to market participants that Litecoin was ready to go. And it just happened at the same time the rest of the crypto space was rallying. So Litecoin went from 100 to 400. This is a 4x return in just a couple of days. And this is not something that is ordinary. This is an extraordinary event that you'll probably only see once every couple of decades. But one thing I want to point out with this chart is that even though Litecoin peaked in early December at about 400 and then went into a downward swing, the point that was resistance earlier, remember this $100 level, then became strong support, because people who had missed that buying area were now sitting here waiting for Litecoin to pull back. So if you had missed this original buy, you could have potentially waited until it came back to 100, or let's say you bought Litecoin on the breakout and sold it somewhere in here. You just really had to wait till it came back to a strong support level at 100 before buying again. Now in the last chart of Litecoin, we looked at how it moved on a linear scale. But I'd like to show you how Litecoin versus the US dollar moved on a daily scale to illustrate that if you had been trading Litecoin for the entire year, a parabolic move like that wasn't necessarily out of the ordinary. So if you look at this on a log scale, you'll notice that the move in early December in Litecoin that took it from $100 to $400 a coin wasn't that out of the ordinary, because in May, you had moves that took it from 10 to 40. And earlier in the year, you had moves that took it from $1 to 4. So you had multiple 4x moves that occurred in just a short period of time in Litecoin. And so when you're thinking about an entry strategy in crypto assets, you should also look at the log scale to see if a move like that has occurred in the past. So that concludes our section on entry strategies. Now at the end of this section, you should be able to select entry points based on technical analysis and identify key support levels using Fibonacci retracements.
A lot of people ask me, when do I exit the market once I've bought in? Now that's a great question, and it really depends on your personal goals for investing in crypto assets. This section is all about exit strategies. At the end of this section, you'll be able to develop a framework for exiting trades and establish and set stops to manage your risk.
There seems to be a belief in the crypto trading community that it's never a loss until you sell. But don't think of it that way. The reality is it's never a profit until you sell. Now, a lot of trading strategies focus on where you should buy, but the truth is you should really consider where you sell. So in this lesson, we're going to talk about exit strategies. And there's two variables to exit strategies that make them so key to your performance in the markets. One, They determine whether you'll make a profit at all, and next, they determine how much of a profit you'll actually make. So exit strategies are even more important than entry strategies because of these two variables. There's a saying in the market, cut your losses short and let your winners run. But how exactly do you accomplish this? Now, there's a couple exits that minimize losses that I want to talk about. The first is the initial stop loss. And this is usually entered when you enter the market and you put a stop loss below where the market is trading so that if the position moves against you, you sell and protect the rest of your capital. Next is the time stop. Now, the time stop isn't necessarily a price level. However, if the trade that you had entered in doesn't seem to be working out, you give it a certain amount of time and then you sell. And lastly is the trailing stop. Now, trailing stops are key because they'll move with the market. So if you buy, let's say, Bitcoin at 10,000 and the price moves up to 12,000, your initial stop, which might have been $500 below your entry point, will move up to 500 below where the market is currently trading. So these trailing stops will help you lock in a profit once the market starts moving in your favor. So let's think about how we're going to maximize profits once we get into a trade. Now, there's two exits that can help you with this. One is using an average true range trailing stop that's 2.7 to 3.4 times the 10-day average true range. And I'll show you that in a second. The next is also channel breakdown stop. So as I showed you in a previous lesson, when markets are trending and they're in a channel, if they break out of this channel, that's where you want to put your stop. So let's get into this right now, and I'll show you how to set stops up on Coinigy, a very popular trading platform in the crypto world. Now, Coinigy is a platform that allows you to access different crypto markets all from the same trading station. So think of Coinigy like a TD Ameritrade or an E-Trade. You can access New York Stock Exchange or the CBOE from E-Trade. Same thing with Coinigy. It allows you to access the Bittrex exchange or the Poloniex exchange or every other exchange you've signed up for. Now I want to show you how to set up a stop in Coinigy using average true ranges. And right now we're looking at a chart of Bitcoin versus the US dollar. This is on the Bitstamp exchange, and this is the daily chart. So each one of these candles, remember, represents 1 day in trading. Below this chart is the average true range, and this is a 10-day average true range. So it's giving me a price movement or an average price movement of Bitcoin versus the dollar over the last 10 days. Now, you'll notice here that the average true range tends to spike when the market's more volatile, and then it starts to come into a lower price point when the market's less volatile. So the average true range I'm looking at right here is about 1,000. Okay, and if I were to buy Bitcoin, let's say at this price point, 10,000, I want to use 3 times the average true range to set my initial stop. So 3 times the average true range, 3 times of 1,000 gets me 3,000. So this is a guidepost to how much lower from the market that I set my initial stop. So 7,000 here on Bitcoin is going to be like putting a stop order down here. Now, the reason why it's important to use the average true range is because you want to understand how volatile is the market, and you want to put your stop far enough away that any short intraday or multi-day moves don't knock you out of the position. If you're constantly having your stops violated because you're putting them too tight, then you have to go back and buy that position again. Now, average true range is going to change for different time frames, and let me show you what it looks like on a 4-hour chart. Now you're looking at a chart of Bitcoin versus the dollar, 240 minutes for each candle, which is 4 hours, and this is on the Bitstamp exchange. And the first thing you'll notice that in the 4-hour time frame, the average true range is much less. It's not $1,000 anymore, it's 300. So our stop loss is going to be 3 times 300 if we're talking about shorter time frames. So if your initial buy of Bitcoin is at 10,000, then your stop is going to be $900 below at 9,100. And this stop will give you enough room to let the market move up and down before it makes its move higher that you're expecting. So it's key to understand what time frame you're considering when you're looking at an entry strategy in order to put your exit at the appropriate point. So this concludes our section on exit strategies. Remember, exits are key in determining not only whether or not you'll make a profit on a trade, but also how much profit you'll make. Now, after this lesson, you should be able to develop a framework for exiting trades, and also you should be able to establish and set stops to better manage your risk.
There's a lot of buzz around initial coin offerings, or ICOs. Now, what are they, and how do they impact the crypto asset markets? Can you even invest in them? In this section, we'll answer all those questions. So at the end of this section, you'll be able to explain the relationship of IPOs and crowdfundings to ICOs, and you'll also be able to evaluate ICOs.
With 2017's rise in the crypto asset markets came the dawn of the initial coin offering, or ICO. Now, ICOs to the cryptocurrency markets are very reminiscent of the initial public offering during the dot-com phase. Now, ICOs are like a hybrid of an IPO and a crowdfunding mechanism. And in these transactions, investors contribute Bitcoin or Ethereum and then receive a new token. It's important to note, though, that just because this transaction has occurred, you don't necessarily receive your tokens immediately. You might have to wait 3, maybe 6 months until the new token is issued. I would also note that for most of these ICOs, the earliest investors receive a discount compared to later stage investors. So let's take a look at some recent offerings on a website called tokendata.io. So Token Data is a great resource that aggregates all initial coin offering information and puts it in one easy to sort area. And when you look at this site, you can see how much US dollar was raised for each of these initial coin offerings. You can see the month when they were raised and the sale price and current price. Now, a couple things I'll note. If you look at Filecoin, which is a very large offering of 200 million, you'll see there's no sale price and current price. And like I noted before, the investors in Filecoin still haven't received their token yet, so it's not free to trade. Same thing with the DAO. This is actually an ICO that failed. Polkadot is another one that was completed, but investors never received their token just yet. So if you scroll down, you can also see the return on some of these ICOs have been astronomical. Here's an ICO called Icon that so far has generated a 34 times return on your initial investment. And here's another one called Electronium, which is an anonymous form of cryptocurrency that returned over 11 times your money. Now, if you want to see some of the upcoming ICOs, if you click on the ICO calendar tab, here are some ICOs that are in the pipeline. It'll tell you what date they will be offered and also how many days you have left to contribute either Bitcoin or Ethereum. You can also look at the white papers of the specific coin that you're thinking about investing in. And so this gives you a really good resource if you're thinking about moving into the initial coin offering market. So let's look at some cryptocurrency ICO stats for 2017. Now this chart gives me an overview of how much capital was raised in 2017. And the first thing you'll note is that $3.7 billion went to ICOs, and this dwarfed the $1.7 billion of venture capital money that went to internet startups. You also note that in the summer was an extremely lucrative time for ICOs. There were months in June and July that raised over $600 billion. In September, you had over $800 billion. Now you're wondering, where did most of this capital go to? Well, the top 10 ICOs accounted for a lot of that aggregate number. Filecoin raised $257 million. Tezos raised $232 million. You have Paragon that raised $183 million. Now, where or what type of projects were investors looking for? The large majority of projects were in the infrastructure space. And second behind that was trading and investing with decentralized and centralized exchanges. You also have 11% going to energy and utilities. So you'll see that the majority of ICOs last year went to infrastructure that are building the backbone of the blockchain ecosystem. With the digital gold rush and the ICO boom in 2017 came scams and frauds and different pump and dump schemes that you need to be cautious about. So if you're thinking about moving into these ICO markets, there's some key considerations you should consider. First, what's the decentralization edge? Specifically, what does the protocol do that's better than the centralized system it's trying to compete against? Next, who are the team and advisors? Now, every single white paper and new protocol and ICO has a group of people behind it that are working to make this plan come to reality. And to look up the team and advisors, you can check out their LinkedIn or their Twitter page. And you want to make sure that these are credible people behind the protocol, because you can't trust a protocol until you trust the people behind it. And lastly, what's the asset supply schedule? Now, in the crypto world, you want to make sure that something has scarcity value. And what I mean by that is you want to buy into protocols that only have a limited amount of tokens that will be issued. For instance, in Bitcoin, it has scarcity value because we know there can only be 21 million Bitcoins in existence, and there's only been 18 million printed so far. So asset supply schedule is key to understanding whether or not it will have value in the future. Now, the ICO boom in 2017 was like the Wild West. Some investors made fortunes while others lost their shirts. So it wasn't long before regulatory agencies in the United States started looking into these ICOs and ruling on them. So the first question that the regulatory bodies wanted to know is, are ICOs securities? And recently, SEC Chairman Jay Clayton ruled, yes, ICOs are securities. They fulfill what's known as the Howey test, which is a framework designed to tell you what a security is, and it was outlined in the Securities Act of 1933. The next question is, do they need to be registered? And the truth is, if something is a security, the new offering needs to be registered. So now ICOs are going to fall under a registration basket where they need to be registered with the SEC. So to buy an ICO, you need to be an accredited investor, which means you need to have a certain level of income and a certain level of net worth. So this is something to think about if you are considering moving into the ICO market. So that concludes our section on ICOs. Now you should be able to explain the relation of IPOs and crowdfunding to ICOs, and also you should be able to evaluate ICOs. Not just consider them as an investment, but also think about how they might be regulated in the future.
There are ways to invest in the crypto asset market without buying cryptocurrencies or investing in ICOs. In fact, there's a whole market of securities now connected to cryptos that are valued uniquely. At the end of this section, you'll be able to make use of these alternative crypto asset investments.
So perhaps you want to invest in the crypto markets, but you're unsure about actually owning a crypto asset. Maybe you don't know where you're going to store the crypto asset, or you're not sure how to get on an exchange. So there's some alternatives to consider. The first is the Bitcoin Investment Trust. Now, this is listed on over-the-counter markets under the ticker symbol GBTC. Every share of GBTC equals 1/1000th of Bitcoin. So if Bitcoin is priced at 10,000, then GBTC should be priced at 10. However, it doesn't really work like that. Additionally, this was launched in May of 2015, so it's a lot newer than Bitcoin. It was also launched by a group called Digital Asset Holdings. Next, this is not an ETF. It may look like an ETF because it's traded on over-the-counter markets, but it's really an exchange-traded trust. And what you're doing is you're buying from accredited investors. And this is an important point, and I'll show you why in a second. And lastly, there's a significant premium over Bitcoin. So let's look at a chart right now of the GBTC versus physical Bitcoin to show you what I mean. So this is a chart of the Bitcoin Investment Trust, GBTC, versus physical Bitcoin. And the first thing you'll notice is that GBTC tends to trade at a significant premium over Bitcoin. Now, GBTC in this chart is priced at $16.92. And we know that every share of GBTC is equivalent to 1/1000th of a Bitcoin. So to get the Bitcoin equivalent price, we multiply by 1,000, and this represents $16,920 worth of Bitcoin. Now, Bitcoin is trading at 98.30, so you can see there's a significant premium from GBTC to Bitcoin, which is over 70%. For the life of the GBTC, it's traded at a significant Bitcoin, except for this one period in 2017 when Bitcoin spiked and the premium went away. So you might be wondering, well, why does the GBTC have so much more of a premium than Bitcoin? And the answer is pretty simple. With the GBTC, you can actually own it in a Roth IRA or a retirement account where you can't own a crypto asset in one of those accounts yet. The other reason is that with the GBTC, you don't actually have to store any coins. The trust takes care of it for you. So if you're thinking about investing in this, just consider that they are a huge premium to Bitcoin, even though it might help you in a retirement account and you won't need to store your crypto asset anywhere. Another way of gaining exposure to the crypto asset class without actually owning a physical crypto asset is with the futures market. Now, in the futures market, you're not trying to predict the future. You're just buying a security that secures delivery at a known price, time, and date. One consideration in the futures market, if you're investing in physical crypto assets, is what do the term structures look like? And I'll talk more about that in a minute. But just so you know, there are a couple places to buy Bitcoin futures. The first is on the CBOE. Ticker symbol is XBT. Now, the CBOE, one contract represents one Bitcoin, and they allow for 40% margins. The second place you can buy a Bitcoin future is on the CME, or the Chicago Mercantile Exchange. In this case, one contract is much larger. It represents 5 Bitcoins, and the margin is 43%. So let's take a look at the term structures right now of Bitcoin and make some sense of them. So in the futures market, sometimes the term structure can be predictive of price moves. Now, the Bitcoin futures market is relatively new and doesn't have a long time frame of futures available. For instance, here is a chart of the term structure of the Bitcoin futures on the CBOE. And you'll notice that there's only 3 months available. There's March, there's April, and May. And right now, the April contract is trading at 99.40, the May contract's at 99.60, and the front month, which is March, is trading at 10.50. And this is a pretty flat slope of a term structure. Sometimes in other commodities, such as oil or natural gas, there'll be backwardation or contango, and that can be predictive of future prices of the actual physical commodity. But right now in the Bitcoin futures market, it's difficult to determine which way price is going because there is a lack of data and a lack of contracts available to trade. But perhaps sometimes in the future, this will be more predictive of pricing. So we've all had this experience before. Somebody gives us an investment tip or we hear of something that's the hot new thing. In the stock market, there are some steps you can take to analyze whether or not this is a viable investment or not. In the crypto market, it's the same way, but there's some key differences. Let me go into them right now. So if you're thinking about a new crypto invest in, the first thing you should look at is the white paper. Now, the white paper is an outline of what the token or the new coin will be used for and how it will be distributed. Next, you want to look at their Telegram channel. Telegram is a messaging app that's available on your desktop or your mobile phone, and you can simply search for that coin on Telegram and see how many people are following it and what are they saying. And you want to make sure it's not just people talking about making money in the coin. You want to see that it solves a real-world problem and has big plans. Next is the issuance schedule. Now, we looked at this at coinmarketcap.com. The issuance schedule is how many coins or tokens available right now versus how many will be available in the future. And this is to make sure that there is some type of scarcity value to it. You don't want to buy any crypto assets that only have 25% of their tokens issued now with another 75% or even more in the future. There'll be no scarcity value. And lastly, you want to think about the decentralization edge. What is the problem that this token or coin is trying to solve? And what is the market for it right now? Can this market be disrupted and can it be decentralized? And if you follow all 4 of these bullet points, you'll have a great way to analyze a new crypto asset idea. So that concludes our section on alternative to physical crypto assets. Now you should be able to make use of alternative crypto asset investments. There are 2 general risks in the crypto markets that you need to be aware of. The first risk is asset risk. And in crypto, it's not like the stock market where your assets are safe at your brokerage account. In the crypto markets, you have to store your digital value somewhere safely. And this carries a much higher risk than any other asset class because someone can hack into an exchange and take your private keys and command your coins and send them elsewhere, or perhaps give you a desktop virus to take your coins out of your desktop wallet. So the asset risk is much higher than any other investment class. Now, in terms of capital risk, this is also higher because crypto assets are highly speculative. There is no intrinsic or very little intrinsic value in any of these crypto assets. There's just no real world use cases that are currently being used for the amount of value that you're buying into. So you have to consider how much speculative value there is in the crypto asset class, and you can see that because the changes in crypto assets or the changes in prices happen 10 to 20%. Sometimes even the smaller crypto assets will move 40 to 50% in a given day. So you have to understand that risk in crypto assets is much different than other investment classes, both on an asset side and on a capital risk side.
Congrats on completing this course. For more education on cryptocurrency, visit the Investopedia Academy and explore the cryptocurrency content on investopedia.com. I'm Ian King. Thanks for joining us.